Okay, I think we're going to go ahead and get started. I know people are still kind of entering, but we're just going to do a few housekeeping things at the beginning before we get started talking about federal grants. So welcome. We're doing another session of quad meetings this year, starting out with this one virtual session. If you're new to the auditor's office, and never been through a quad before, I'll kind of explain to you how this is set up. We do these as a little bit smaller individualized groups. So we start with a virtual meeting like today. We'll do presentations over the things that we really want to discuss. This is really a place for you to have a takeaway. So think about questions that you have within these presentations that we give. We want you to bring them to the actual in-person quad meetings. That is where our discussions are going to take place. So we'll dig deeper into these presentations. We'll walk you through some stuff, brainstorm with you, have a Q&A session at that point where we can kind of talk it through, and then any other additional questions that you have will be done at that time as well. It's a good way for us to get to know you guys on a little bit more of a personal level, and you get to kind of know us versus standing up in front and talking to all of you at one time. So they are kind of a neat thing to do, and we look forward to seeing you guys in the next couple of weeks as we come out. So if you noticed, we did mute you when you came in, when you walked in. When you came in, we muted you. That is just so that we don't have all the background noise. It's an automatic setting within WebEx, so you don't need your microphones. You are welcome to use the chat function. So if you've got a question during the presentation, we will be monitoring it. We'll try to answer it as we go along. Again, there's not a Q&A session today. We want you to save those questions for the actual in-person meetings, but if you have a question about something that we said or things like that, please put it in the chat and we'll try to answer it as we go through. You will get a certification for today's meeting for attending and for the in-person meetings. Remember, these in-person meetings are going to be in the span of 2 weeks. So by the time we get all of that back, it's probably going to be June before you get those certifications. So just, be aware of that. It does get a little bit more confusing when we have different locations and a virtual setting. All right. For the in-person meetings, will we receive a list of attendees? Of the virtual or the in-person? I'm not sure what you're asking there, Deborah. I don't know, maybe we can talk about it later if you're wanting it for the association. I can kind of get an idea of what you're looking for. There will be, so for the in-person meeting, sometimes we have extra handouts. We do not have any extra handouts for you this time around. So the only thing you need to bring is yourselves, maybe a pen, some paper, things like that to write down. But again, we want you to take the notes and to have the conversations, bring your questions, that kind of thing. But there's nothing else that you need to go get and print in order to attend the in-person meetings. If you want to print the presentations that we're presenting today, those topics do, again, bleed over into that. We're just presenting today and we'll break them down at the actual in-person meeting. Okay, the last thing that I have on my list here to talk about is experienced auditors. Some of this is going to be a little bit familiar with you. Please remember, we do have a lot of new auditors. We have a lot of new treasurers too, as we're going to bring them in at during the afternoons of the in-person meetings and even today. So please help them, share your experience with them, especially during these in-person meetings. We're just want to start kind of a foundation with them today as well, so that they can build upon their learning and be able to hopefully get something out of it to make their job a little more efficient. Okay, ladies, did I miss anything? Okay, super fun. Okay. Oh, I did miss one thing. We're recording this. So I do know that there are several who could not attend the virtual meeting due to one thing or another. So we are recording it. I will attempt to get this downloaded today and sent to our webmaster to get put up, hopefully by tomorrow. so that anybody who isn't able to attend can maybe see it before they come to the in-person meeting. So if you are aware of anyone who isn't here and would like to watch it, please let them know that should be available. Again, I will try my hardest to get it today, to download it today and get it to them. Okay. All right. Now let's, oh, I guess I should introduce you guys too, right? So sorry, I just assumed that you know who we are. So I am Ricky Hofer. I am one of what we call the GTAC directors for counties. I am joined today by Stacy Burns. She is another one of the GTAC directors for counties. And then we have Lori Rogers, who is the GTAC director of directors, but is still helping with counties. Is that, I don't know what your official title is now. She's not, I can't hear you again.
Can you hear me now?
Yes. Okay, say one more thing to make sure.
One more thing.
Perfect. All right, guys, let's get started. We are going to talk about federal grants to start with. It's a big presentation. Let me minimize, make sure everything is up. All right. All right, what's everybody seeing? We seeing just the presentation?
Yes.
Perfect. Okay, let me move us out of the way. Okay, well, again, good morning. We're going to start this morning by discussing some federal awards. If you were at the fall conference, you will remember that I did a very high level, very technical presentation on the auditing of federal awards. I used that presentation as the basis for this presentation, so they really should work in conjunction with each other in order to break down these compliance requirements and how they are accomplished at your local level. So this presentation is done very much in the same format. In fact, some of the slides are going to look almost identical to what they looked. I'm just hoping to give you a little bit additional information into it from a different perspective. So we went from the audit, why we do what we do, where we get our information, what we audit. Now, like, what do you do to accomplish those tasks? So I'm trying to kind of bridge that gap a little bit. All right, all these presentations, including the one that I did in the fall, will be available on the website. In fact, the one from the fall is already up there. I think this one's up there too. They're both going to be in the resource library. If you do have an issue finding them, just send us an email and we'll help you. I also want to mention there are a lot of federal awards. There's a lot to them. From the application process to receiving the award itself, to the record keeping, to the reporting, to all the compliance requirements that need to be met. And while the auditor tends to be our main contact during the audit of these awards, it's not always the auditor's responsibility to meet every compliance requirement for every federal award. That would be a daunting task. So the departments who are out here applying for these federal awards should take an ownership in some of the responsibilities in order to maintain compliance. So I'm going to kind of go through, I'll be breaking it down through the presentation. I'm going to try and do it per compliance requirement again. But remember, I can't assign responsibility for each of these compliance requirements, as this is a management decision, meaning that it should be determined at the local level. So what will work for one county may not work for another. But I can help you take a look and see where that responsibility might fit the best. But again, it would still come up to a local decision of where it lies. So let's get started. Let's take a look at how this information is gathered and the steps that the county can take to stay in compliance. So we're going to begin with the schedule of expenditures of federal awards, or as we refer to it, the CFA. So as you're aware, all the information on this slide is what you enter under the grant section of the annual financial report that's due March 1st. All the information listed here is required to be entered in order to have a proper CFA. The information comes from various sources, and I tried to mark this information above. All right, so let's begin with the list on the left side of the screen, right? So we're starting with your local project name, your grant project title, your agency name, the pass-through agency, the assistant listing number, which was formerly known as the CFDA number, the award name, the award number, and whether the grant is an advanced grant or a reimbursement. All of these items are really identifying information, and they should be provided at the time the county receives the award. This information should be available within your grant agreement. If the information is not given to the county, you'll need to contact the grantor agency, so the agency that awarded the grant. Any communication that you receive with your grantor agency should be saved and stored within your grant file. On the right side of the screen, this is information required for what the county did with the funds, right? So you've got the fund name is given to the fund, recorded in the ledger, right? So you're going to go to your ledger, you're going to look and see what fund it is. What was that fund name that you gave it? Hopefully it's within the 8,000 series per the chart of accounts. Both receipts and disbursements are entered and should also come from that fund's ledger. All transactions should be within the grant fund as well. Subrecipient information should come from a couple places. The amount dispersed should come from the grant fund within the ledger, and there should be agreements in place for all subawards given. The other three things here, loans outstanding, non-cash assistance, and insurance, are specific requirements for certain grants. And if you come across one of these, let us know, as we'll help you determine where that information should be available. In most cases, these are not applicable, but you really need to look at the grant itself to make sure of that. The big takeaway here is this schedule is very important, and the information entered is one of the first things reviewed when State Board of Accounts is planning our audits for the year. The CFA is reviewed for accuracy and then used to determine if a single audit is required. So a single audit is required for any unit that has 750,000 or more in federal expenditures. Once accuracy is verified and if a single audit threshold is met, the audit determines which programs will be audited as major programs. So we went through that determination process last fall, so I will not repeat that information here. But once a major program is selected, we move on to testing it for all the compliance requirements applicable. For this presentation, we'll briefly be touching on all of them and then dig a little deeper in the in-person meetings. All right, so to begin with, there are certain financial management requirements that should be in place and are required for all federal awards. These are listed here on the slide and are outlined in more detail in 2 CFR 200.302. Let's take a look at what's needed or how these requirements are met at the local level. So the first requirement is identifying all federal awards received. This is accomplished by entering the grant information when filling out the annual financial report. The grant information that is entered is run through a macro, which reformats the information into the schedule of expenditures of federal awards. The second item here is the disclosure of financial results for each federal award. After the single audit is completed, the county is required to disclose the results of the single audit. This includes any findings associated with the CFA itself, along with any findings for major programs. This is accomplished by certifying the data collection form at the end of the audit. This form is started and the information is entered by the State Board of Accounts. And then at the end of the audit, the auditor is required to go in and certify this report. Once the data collection form is certified, the information is available. This normally comes in the form of an email. If you've ever received one, it'll have like a login where you'll go and you'll basically press a button to certify. Moving on, supporting records. This is federal awards come with a lot of paperwork. Not only are you required to maintain grant agreements, award letters, communications with the grantor agency, there is also a requirement to maintain all supporting records for transactions that involve these federal awards. Supporting documents could be claims, invoices, contracts, subrecipient agreements, receipts, ACH notification, etc. All this documentation goes to support that the awards were used and recorded properly. Okay, the next 4 items all revolve around local policies. So federal awards require a robust and effective internal control system. Internal controls are a vital part of any and all federal awards. Local units are required to have internal controls in place for each compliance requirement outlined in the supplement. We always talk about internal controls and segregation of duties, which is the important step in effective internal controls. While we'll be touching on internal controls for the compliance requirements, we won't be going in on a deep dive in this part, as Stacy's going to be discussing this later. The county should have local policies in place for these internal controls, and we do recommend having them written so that everyone knows their responsibilities, what processes are in place, and how they're monitored and assessed to make sure that they're in compliance. This also helps to prevent errors, fraud, and any other non-compliance. As always, a comparison of the budget for the federal awards to actual expenditures should be taken place just like you do with any other fund, and they should not be spent in excess of the budget. Another policy required is for federal payment. This policy is required to be written and should provide procedures in place to help minimize the amount of time between receiving an advance payment and paying out a disbursement. But we'll be discussing that a little bit later in more detail. And the last one on the list here is a policy that is, again, required to be written. This is for determining allowable cost for a federal award. We'll be discussing this with allowable costs in a couple more slides. So as you can see, there are still requirements that must be maintained for compliance with all federal awards. They work in conjunction with each compliance requirement. And we're about to go through them as they are vitally important to the financial management of all federal awards. There we go. I can't not do a slide on internal controls because, again, they are a vital part. But this slide is just to recap information that we went through. But also to remind everyone that communication on what controls have been put into place and the documentation to look for needs to be provided during the audit. Remember, internal controls in place need to be documented. And that internal controls are ever changing. So they should always be monitored to make sure that they are being effective, and a risk assessment should be performed, especially when any changes are made or when internal controls have been determined to be ineffective. As I said earlier, Stacy will be going into this in more detail later this afternoon. All right, so let's move on and start talking about the actual compliance requirements. I do want to note, if you remember from the fall or if you weren't there, that not all compliance requirements are applicable to all grants. nor do all compliance requirements require an audit for each federal program. Each federal program should be evaluated and reviewed for the compliance requirements that are applicable to it. Okay? These are identified in federal regulations, the compliance supplement, terms and conditions of the grant. And again, we'll be touching on each one of these at a high level just to give you an idea of the requirement and how and what needs to be done at the local. Okay. So we begin with activities allowed or unallowed. Okay. This compliance requirement is unique to each federal award. And the allowable activities should be identified using the grant agreement, federal statutes and regulations, along with identifying the allowable activities. You should also identify if there are any specific unallowable activities. The grant agreement should reference different federal statutes and regulations to help you in this process. For example, when determining an activity allowed for, let's say, child support enforcement, your 4D grants, costs associated with the highway would be an activity that would not be allowed, right? So, 4D is not going to be supporting highway projects or highway things, and vice versa. Highway wouldn't be supporting the 4D. So that's the activity that would be not allowed. Activities allowed and unallowed sort of go hand in hand with the next compliance requirement. So let's talk about allowable costs, and then we're going to circle back about how these two are connected and how they work for your county. All right. So allowable costs and cost principles. This is centered around the cost of what was actually purchased within the allowable activity. Examples of costs could be supplies, salaries, vehicles, food, etc. Allowable costs can be different from award to award and fall into one of two categories. An allowable cost can either be a direct cost associated with the grant, as in like maybe a required service of the award. If you're contracting out that service, okay, that would be a direct because it's acting as part of your program or fulfilling the grant agreement. Or a cost can be considered an indirect cost associated with the grant, such as a portion of maybe a utility bill, right? So for an office, if you have an office space inside of your courthouse and that office, we can use your 4D again. Sometimes they have offices and you can charge part of your utility costs for the lighting in that office to the grant. All right, so whether a cost is direct or indirect, again, should be identified as requirements are a little different depending. Direct costs are more straightforward. Typically an invoice or a contract will be available for these, whereas indirect costs require things such as a cost allocation plan. Again, child support enforcement uses indirect costs, and typically the county uses a company to come in and create that cost allocation plan so those indirect costs can be apportioned correctly to the grant. If you do have a cost allocation plan, this would be a required document that would be needed to be given to our field staff during the audit. Once a determination has been made between direct and indirect costs, the county needs to look to determine what costs are allowable per the program. So this slide references 2 CFR Part 200, Subpart E, which outlines the cost principle and which things that are allowable per federal regulations, and also has a list of things that are never allowable. And just like any other transactions, all supporting documentation must be maintained of these costs. We'll go into this further in just a second. So this brings us to whose responsibility is it to determine the allowable cost within a federal program? Should it be the auditor? Should it be the department? Should it be the commissioners? All of these offices play a part in the acceptance of the federal award, agreeing to meet all the requirements by entering into the agreement. So where do the responsibilities lie? This is where the allowable cost policy comes in. So if you remember a few slides ago, we talked about financial management, and this is one of the requirements that was listed. This policy needs to address how allowable costs are identified and whose responsibility it is to do that, along with documentation when it has occurred. There should be internal controls in place to make sure that the proper procedures have been gone through to determine allowability of costs. We will be discussing this policy again in the in-person meeting and really kind of trying to do more of a brainstorm of how we can get these created and going for your county. So what documentation is required for allowable costs and allowable activities? What procedures are performed at the local level that can help you meet these requirements? Let's take a look. Okay, so now we've talked about allowable activities, allowable costs, and how they are kind of interwoven. They are separate, so you could have a cost that's allowable but not for an allowable activity, and you could have something that's for an allowable activity but the cost itself is not okay. But they are typically audited together as the same documentation helps support each of these compliance requirements. So let's look at a few examples. Let's say we are the Child Support Enforcement Office, okay, and we want to use federal awards. If we purchased a bulldozer, that would not be an allowable activity or an allowable cost, as it does not relate to child support enforcement. But if we were to purchase office supplies, but let's say these office supplies were for the health department, while the supplies while the supplies are an allowable cost, it would not be for an allowable activity because, again, it doesn't support child support enforcement. But if you purchased office supplies for the 4D office, then you would have an allowable activity and allowable cost. Sorry, my mouse messed up and it just shoop on my screen. All right, so you can see it's important to look at the activity involved along with the associated cost. Claims against federal awards should run through the normal claim process that is set out in statute and should include a fully itemized invoice, bill, or contract. The invoice, bill should be approved by the officer or person who is receiving the goods or services. The auditor will still certify that the invoice bill is true and correct. If there's a contract involved, then the auditor will verify that claim agrees to the contract. If it's for payroll, the auditor will treat this as it does other payroll claims and verify that payment. And it should agree to the salary ordinance. Once verification has been completed, the claim should then go through the proper approval process before being paid. One thing that should be made clear is that the allowable activity and the allowable cost should be determined before the purchase is made and should follow the allowable cost policy. These are federal dollars that are being spent, and any misappropriation could result in the county receiving less money or not receiving any at all. So every step should be taken to ensure that the money is being spent accordingly. Does this mean the auditor is in charge of this? No. The auditor plays a vital role in making sure that the claims meet the certain requirements, but will probably not be able to tell what what is allowable for each and every grant the county has. The departments that are spending these grants should know what activities and costs are allowable and should document their process. This does not mean, however, that as auditor, you shouldn't question a claim. Again, if 4D is buying a bulldozer, you probably want to ask a few questions. The allowable cost policy must be written and should include these responsibilities and determinations. All documentation should be maintained for these determinations, as these will be used during the audit process. There we go. All right, let's move to cash management. So, depending on the federal program, cash management could have further requirements outlined within the terms and conditions of the award. For example, some awards have rules about cash balances being held, a minimum or a maximum allowed amount. For advanced awards that are drawn down when needed to pay for costs incurred, there is a requirement to minimize the amount of time between drawing down the funds and dispersing the funds. This compliance requirement is set in place so that once your costs are incurred, you request the money is then drawn down so that the money is then paid out. The payment should occur relatively close within a few days of receiving the funds. These could be there could be stricter rules, so make sure that you look at your grant agreements. If this requirement is applicable to one of the federal awards, the county needs to evaluate how this process should take place. While the department knows what costs have been incurred and maybe even initiated the request for the drawdown of the money, they won't be able to see when those funds hit the bank. The auditor won't be able to see when those funds hit the bank either. So the treasurer is going to have to play a role to notify what responsible party when the funds were available to use. And then the auditor would then run the claim process for the payment. So as you can see, it's going to be, there's multiple parts to each process as there's multiple departments that will be involved. Payments to subrecipients would also need to be reviewed for timing. Is the money given in advance? If so, are they required to have costs incurred? Is there monitoring that the subrecipient spends the money as soon as they receive it? If that's the case, again, subrecipients is its own compliance requirement, and we'll dig into that a little bit later. But I do want you to understand that some compliance requirements have effects on other compliance requirements. While advance awards do happen, reimbursement awards are probably the most common. Reimbursement awards require the county to request reimbursement for costs or claims already paid. So the reimbursement request is a type of report. So again, this affects the reporting requirements that we're going to discuss later. And is required in order to be reimbursed for costs paid. These requests should be supported by claims in which the totals of the claims paid agree to the amount requested to the penny. The claims being requested for reimbursement should also be for allowable costs and allowable activities within the grant. If the county is giving a subaward on a reimbursement basis, then the county should be verifying that claims being reimbursed have also been paid. So who should request a reimbursement? Again, this comes down to a local decision, but it should be someone who's familiar with the award, who is monitoring that grant fund as disbursements are being made and is requesting that reimbursement for those disbursements in a timely manner. While the auditor should be monitoring the funds for any overspending occurring, even within grant funds, a reimbursable grant is allowed to be negative for a reasonable period of time. And I know we don't like to say reasonable period of time, but this should be only negative in the time that you are requesting you've spent the money, you request reimbursement, you're following the requirements for the reimbursement. So is it monthly? Is it quarterly? So if it's monthly, there's been disbursements for that month. It is only negative until you receive that reimbursement request. It should then zero out the fund and should not stay negative or be negative into future periods. Okay. Eligibility. Eligibility requirements, again, are unique to each federal award. And while they can happen, it's not necessarily common for awards received by the county to have an eligibility requirement. But just in case, we need to know that information. If the grant agreement requires eligibility to be performed, a knowledgeable person of the award should identify what the eligibility requirements are. These requirements should be followed to determine the eligibility of either an individual or maybe a group or a service area. Eligibility could also flow through to subrecipients, depending. Once the requirements are determined per grant agreement, a process needs to be developed by the county in order to test for eligibility and document any and all results. So any and all results of eligibility need to be maintained as supporting documentation, regardless of whether they passed eligibility or they failed. So we would be reviewing that documentation for that support. It just goes to show that the process was done and you were in compliance. Depending on the eligibility requirement, would depend on who in the county could be responsible. So for example, one of the things I was thinking is the SLFRF funds. I know that there were a lot of counties who created committees to kind of talk about this, especially if they were awarding out to other entities. And so there was kind of an eligibility process that was happening. So in that case, if there's a committee that's going through that process, then document that process and provide that information if needed. Okay. Equipment and real property management. It is defined in the Code of Federal Regulations. I've listed it here on the slide. This one, when you look at it, looks like a lot of information when you read through all of the rules. But these are just requirements on how some items are purchased and how they are used in accordance with a federal award. There's also rules around disposal. But luckily, equipment and real property management is handled very similarly to how your purchases of capital assets are made with your local public dollars. And the great thing about this is the county already has a system in place to account for these purchases of equipment and real property. So adding this with the ones that you're purchasing with federal award money should be a little easier. Equipment and real property purchased with federal awards is required to be included on an inventory listing. This can coincide with the list, again, that you've already got in place. It does need to have a notation that it was purchased with federal dollars. So I should be able to look at an inventory list if I come and if I see a vehicle, there should be some sort of notation there that lets me know that that item, that equipment, that vehicle was purchased with federal dollars. Federal regulations do require that an inventory be taken every 2 years, which just happens to be the same as our accounting and uniform compliance guidance for all assets. So again, this should kind of meld right into the system you already have in place. For the county, you have a lot of assets, right? You have a lot of departments who have assets. You have sheriffs who have vehicles. You have the highway and all of their departmental things. I know that the departments and in a lot of counties take responsibility for some inventory listing. It may not be a perfect system, but I know that we are all working towards getting that. So departments should be responsible for knowing what their inventory is, right? What their inventory listing is. They should be able to inventory that every 2 years. They need to work with the auditor because the auditor is responsible for reporting the capital assets for the county. Capital assets, which are a little bit different from inventory, if you remember, capital assets have to meet or exceed the threshold that's set out in the capitalization policy. There needs to be adequate control system in place to develop adequate safeguards to prevent loss, damage, and theft. And all of these should be documented. If the county has equipment or real property that was purchased with federal dollars and they're wanting to dispose of this, they really need to reach out to the federal awarding agency and follow the instructions given. Maintain that documentation too. Any communication with the grantor agency should be maintained. Okay. Matching level of effort and earmarking. This compliance requirement is made up of 3 parts. One or more may be applicable, and sometimes not even one of them are applicable. Each component of this compliance requirement, again, will be unique as it's really centered around benchmarks. So it's important to ensure which requirements are applicable, are identified, and that there have been steps taken to make or to keep the county in compliance. Let's start with matching. Matching is probably the component of this compliance requirement you will see the most, right? You see this within your highway grants a lot as they require a local match of local dollars to be put with the federal funding in order to complete a project. So matching funds can be handled in one of 2 ways. If you have a grant that requires a local match, you can transfer that local match from the fund to the grant fund and spend it directly from there. Okay. Documentation needs to be maintained showing that that local match was transferred to the grant fund and showing that that will show that that requirement has been met. All right. One thing to remember is that if you do transfer the match to the grant fund, the match is not reported on the schedule of expenditures of federal awards, right? We only report the federal dollars on that. So make sure that you track it and you know how much of it was the matching, the local match. You can also spend the local match from the fund it was going. So if you were going to use general fund as the local match, you could spend the local match out of the general fund. You would need to maintain documentation that you met that requirement, probably a list of claims that were spent on that project that would total up to that local match. But regardless of which way you decide to handle the matching funds, documentation is really key here. But since it involves the fund ledger, this responsibility could fall on the auditor. Another component of this compliance requirement is level of effort. So level of effort includes specific benchmarks for things like level of service that have to be provided or a specified level of expenditures for specified activities. This is also where we look to make sure that the federal funds coming in are supplementing your funds, not supplanting them. If this compliance requirement's applicable, it may require calculations and determinations that the level of effort benchmarks have been met. There are sometimes reporting standards that also work with level of effort. And this compliance requirement, again, should be someone who is familiar and knowledgeable about the grant. But no matter who performs, the required calculations or determinations, they need to be gathered together and may need the auditor to assist if the auditor is not performing this in order to get maybe required reports. So maybe they need a transaction history or a fund report. They may come to you, but those reports should be kept with any of the determinations. Does it need to be kept in the auditor's office? Not necessarily. Where you keep the paperwork is really, again, a local decision. It just needs to be maintained. The last component of this compliance requirement is earmarking. So earmarking normally requires like a specified minimum or a maximum amount, sometimes maybe a percentage of the funding, and it must be used for a specified activity. So you got a grant and, 10,000 of it must go to a program, some program run by the county. This can even include funds given to subrecipients. So you could have a grant agreement that says, you've got $50,000, but 10,000 has to be passed through to subrecipients. So as you see, the compliance requirements do sometimes affect others. So you may have to keep a subledger for this in order to track, so that you're not spending that money that is supposed to be earmarked for something else. And anything that you use at the local level to document that these benchmarks, again, are met, are to be maintained. I think I've said that with every slide, but it's so important. All right, period of performance. So this is a set period of time that the federal award can be used. This compliance requirement is normally tested along with allowable costs and allowable activities. So period of performance varies from grant to grant and is normally established within the agreement itself. So when the grant is awarded to the county, the period of performance needs to be identified. And again, controls should be in place to determine compliance with this attribute. Some federal awards do allow for spending after like the end of the period of performance, but it may need authorization from the awarding agency. But again, this is very, very specific inside your grant agreement. So some might say, 120 days after the end of the fiscal year, things like that. All funds and financial obligations incurred should be paid out within the period of performance. The period of performance could extend through multiple budget cycles as well. You could have a grant that goes 2 years. Period of performance should also be monitored throughout the use of the grant and can be done in several ways, but again, needs to be a county decision how to move forward on it. But it could be done by the department, right? As the department is incurring expenses, they should be aware of how much grant money they have left and the time period they have to spend it in. All right, procurement, suspension, and debarment. This is one of our compliance requirements that during an audit we probably have the most issues with. Okay. So if you remember, at the beginning of the presentation, we talked about these financial management requirements. And on one of those was that written policies should be, there should be written policies for procurement. We are going to talk about this and brainstorm what this policy should look like in our in-person meetings. But I just need you to know that it's required for now. Procurement can be tricky, right? Sometimes you have to remember that there's a hierarchy, right, of regulations and statutes. So we look at the federal law first. It has all the rules and guidelines, and then you have state statute, which comes in, which could be a little more restrictive, followed by your local policy, which could be even a little more restrictive. Okay, but it can't be less, right? You can't have a state statute or a local policy that undoes something above it. All right, there's a hierarchy. So at the county level, there should be some oversight for any contractor's performance. There should be oversight of awarding contracts to only responsible contractors, maintaining a document history of all procurements. All procurement transactions should be conducted in a manner that provides for full and open competition. Depending on the type of procurement, there could be special rules if it's a micro purchase or a small purchase, or maybe the acquisition that you're wanting will exceed the threshold for public works. So we're going to be looking that you follow the appropriate set of rules with each procurement purchase. Your attorneys can help you to identify where they think this falls and which procedure might be the best to follow. Just have that documented if you get any kind of opinion on that. So we know state statute already sets guidelines for public purchases. And public works. So federal law, again, is a little more restrictive, but you already have stuff set in place for this. So you just need to maybe adapt it and use it as a starting point for your federal purchases. All right, one last thing I want to talk about here, because like I said, we're going to really, really dig into this, is suspension and debarment. Suspension and debarment is required for all transactions, okay? We're going to walk through examples and how to do this in the in-person meetings. But when you have a contract involved, you have an agreement, you have a sub-recipient, or you have any the compliance supplement says any single transaction over $25,000, there has to be a verification that that vendor is not suspended or debarred. Okay, this certification can be provided by the vendor itself. It can be included within a contract, or the county can manually check it at the SAMS.gov website. Okay. Okay. Program income. Program income is earned by the county. It's from a program that is directly supported from federal funding. Okay. These would be if you were running a federal program with federal dollars, and maybe you charged a fee for a service that was performed. Or sometimes there's rental, like if you rented a building for something, or you've collected a fee because of that program that's funded by that federal. That could be considered program income. I don't see a lot of these through the county, so you need to really look at it, closely. It is not, however, interest earned. So federal dollars that you get, that maybe you've earned a little bit of interest in the bank, that interest is not considered program income. Okay. If you have a grant where program income is generated, it would need to be properly recorded, reported, and used. So there may be allowable activity, allowable cost restrictions on that program income. Again, this should be all within your compliance requirement. The program income would need to be recorded within the ledger, the auditor's ledger, and may require reporting of the amount of program income received to the federal awarding agency. Oh, I forgot to hit the button there. Okay. All right. I know this is a lot of information. So one of the most important compliance requirements, while they're all important, is reporting. Reporting allows for the monitoring of the use of the federal award during the period of performance. There are different kinds of reports that are usually done. Your financial reports can be done monthly, annually, quarterly. Examples of this are also your requests for reimbursement or requests for an advance. The form that you submit is actually a required report and would fall under this compliance requirement. There are performance reports, which have specific benchmarks outlined. And there's also some special reporting requirements. Examples of this could be reporting on subrecipients. Again, if you have program income. I don't ever want to say always, and you never want to say never. So almost always there's a reporting requirement with every federal grant. The required reports should be identified and then determined locally who is the right party to do that. Okay. These reports should be submitted timely according to any due dates given in the grant agreement. They should be completed accurately using amounts supported by the ledger, along with any calculations that might need to be done. I only have like 6 minutes left. All right. So, subrecipient monitoring. So a subrecipient is defined as an entity that receives a subaward for the purpose of carrying out a portion of the federal award. So when a county decides to pass through a federal award to a subrecipient, an agreement must be in place, much like the agreement the county has entered into when they accepted the award. The subaward must be clearly identified and should include the federal award information, all requirements imposed by the county, if applicable, any indirect cost rates, and a requirement that the subrecipient lets the auditors have access to the information, and that the appropriate terms and conditions concerning any closeout of the award. Just like you should receive a lot of that information in your grant agreement, they should receive it as well. Since the subrecipient is receiving a subaward for the purpose of carrying out a portion of the federal award, the county is required to monitor the activities of the subrecipient as necessary to ensure it's being used for authorized purchases. Monitoring can look a little different grant to grant, and there might be certain requirements depending on which ones the county has. Sometimes it could be involving invoices paid before approving a reimbursement request. Maybe they have to submit those claims. Maybe they have to prepare reports that are submitted on the use of their award. Maybe the county goes and does some like on-site monitoring, okay, or on-site reviews. Those are all different ways that monitoring can occur. And again, these requirements should be outlined in the subrecipient agreement. And a copy of that agreement really needs to be with the auditor, even if the auditor isn't doing the monitoring, okay? That agreement is what you would tie your claim back to, right? So when you have, if you're giving money as a subaward and a claim comes to you to give them money, that agreement is what supports that claim. The auditor, or as auditor, you are required to report the amount of federal dollars you pass through to subrecipients. This isn't a detailed listing, it's just in total, but you should keep a listing to know who received money as a subrecipient, and that listing should total the amount you reported on the CFA. We're not going to touch a whole lot on special tests and provisions here. Because they are vastly different from grant to grant to grant. There's not a one size fits all for this. So if you come across a grant that's got some special tests and provisions and you need help, give Stacy, Lori, or I a call. Okay, you'll have to provide us the grant agreement so we can kind of look into it. We can kind of help brainstorm with you how to meet that compliance requirement. So this is the last compliance requirement that could be material to any of your federal programs and has a possibility of being audited. I added some resources here. This is where I gathered all the compliance requirements, the information from. If you don't know anything about your grant, it's a great place to go and get that information. If you have questions navigating it, give us a call. It's a big, the supplement is huge. It's a very, very large document, but we'll help you navigate it. You can also look in the compliance supplement. In the first part of it, they have what they call a matrix that includes a vast number of federal awards by the award listing number. It is not all inclusive. There are some that are not listed here, and if you happen to have one of those, it's a little bit more involved to figure out which ones actually apply. You know, again, not all are going to apply to every grant. Maybe only 5 or 6 will apply. So it's something you need to know grant to grant. And with my minute left, let's see. Okay. So as you can see, there's a lot of moving parts here, and it is going to involve more than just the auditor's office. It's going to involve your departments. They should work closely with you, right? So that you have the information you need to be able to do the things like make the payment or initiate that claims process, those kinds of things. Your commissioners, they enter into the agreements, right? They are the contracting body for the county. So they should be aware of what's going on too. And anyone else that plays a vital role, your treasurers, right? I mean, they play a part in too, especially if you're getting money that's drawn down and hitting the bank account. That's part of where they're going to need to be involved. So it's super important that the county comes together to actually just line out who's responsible for which part of the grant. Okay. The last thing I kind of want to touch on is if we come in and we do a single audit and there is a Section 3 finding that's pertaining to a major program, okay, a highway grant, 4D, whatever the major program might be. A corrective action plan will need to be filled out and will become part of the reporting package. The corrective action plan does ask for the contact person responsible for this corrective action plan, and again, should be a person knowledgeable about the grant and has the ability to affect change. All right. As we move into the in-person meetings in the next few weeks, we're going to really start discussions around each of these compliance requirements and take a look at what's going on in your office, how you process some of these requests, maybe how some of your departments play a part, and look at what works for you. So please be prepared to bring your ideas so that we can have a engaging discussion about them and maybe help other counties along the way. And really in hopes of making this process a little more smoother. So the goal of my presentation today, and really for the rest of today, is really to help reduce the number of findings that we're seeing in both the financial statements and the federal single audit. And we hope that this is going to be a good resource for you for the future. All right, I went over 2 minutes. So I'm sorry, Stacy. So Stacy is going to talk about repeat findings. Is that right?
Yes, sorry, I was responding to a message that popped up. So you don't need to sign up for in-person meetings. You guys have all been placed in areas within like what is it, a 2-hour drive from your home.
Within a 2-hour drive.
So so we've set up 4 locations, and if that date doesn't work and you need to drive to a different location, they are listed on the original call letter. So if you just need to move to a different site, just let us know, because I think it's the Marshall County is the smaller of all of the 4 areas. So, okay, this is my first time doing this, so let me figure out, I share. And oh, I need to make this presenting correct. Yes. Let's see. What do we see? My presentation?
Yes.
Okay, perfect. Okie dokie. Let's talk about repeat findings. Again, like Ricky said, my name's Stacy Burns. I am one of the new GTAC directors, so you might have seen my name on some emails as of late. Or I could have been on an audit site. I just wanted to introduce myself and tell you a little bit about me. I wasn't able to make it to the fall conference, and I'll tell you why in a minute. But since I'm new to this position, I've been with the State Board of Accounts for 8 years. I did intern for a year and a half in our not-for-profit division. Me and my husband have been together 13 years, been married 2, and last fall we had a little boy named Marshall Lane. He decided to make his appearance 2 months early, so I planned on going to your guys' conference, but Lori and Ricky decided that they did not want to deliver my baby. So it was decided that I was probably going to skip it anyway. But he decided to make his appearance. And I know that you guys are just so excited to talk about repeat findings, but I figured you guys would maybe enjoy looking at some photos of him. So again, he's 8 months old. He's a sweet little nugget, like I like to call him. All these pictures depict him perfectly. He's a huge mama's boy. He loves sitting up. His passy is his favorite thing on the planet, and I call him my marshmallow. Again, my husband said I'm not allowed to call him that in person because that could be embarrassing, but he's 8 months old, so I do what I want. And of course, he loves his little jean overalls because his dad wears them all the time, so gotta match dad. Again, this is a big part of my life, and if you guys want pictures, I will continue to show you pictures. I love showing pictures of him, but I know you all can't wait to hear about repeat findings, so we will get to why we're really here today. So your hearts are all breaking because he's adorable, so let's move on. Topics. When we're discussing repeat findings, there are a lot of topics that can be discussed. Today, I'm going to touch on what are findings, what to expect at exit, official response, repeat findings, and what those entail, understanding the finding, corrective action plans, and repeat comment trends. Again, I know for many of you seasoned auditors, this might be some repeat information, but for a lot of new people, you guys are going into your very first audits. And so you might be seeing some of our field staff in there already. So this might be very good information that you can relate to very quickly. So what are findings? Let's start with the basics. This might be a refresher again for some. So let's just get into it. There are several types of audit findings, which we will discuss. During an audit, a control deficiency or a noncompliance issue can be found by our field examiners, which can be potential findings or comments. In the past, we reported all noncompliance issues in the public report, but that approach has changed due to new laws on repeat findings. If the deficiency or noncompliance is neither significant nor impactful, you may receive what we call a verbal comment, MFC, matter for consideration. That is a discussion. This is just a discussion between the field examiner and you. The comment is not provided to your governing board or placed in a public report. This decision is made by our field examiners and depends on the facts as they pertain to your county. We discuss it with you and determine why this issue has happened and if this was an isolated incident. We may consider that it was not significant or impactful to your office. You should note that even though it is not a comment in the report, you should still review your controls over the area of your office and determine if there are any deficiencies in your controls and address or correct those deficiencies before a larger problem ensues. So if it was identified as a random incident, it could be bigger down the road. So just make sure to look into those, even though it is a verbal comment. The next level of reporting would be a management letter or non-compliance on internal controls. This would be for a more significant problem than a verbal comment, but doesn't raise to the level of a comment in a public report. This is especially true for internal control issues. Unlike a verbal comment with a management letter, the information is conveyed to you in writing and also conveyed to your governing board in writing. A management letter is not a public document like an audit report would be. Again, you should understand that the issues raised in the management letter and address any internal control issues so that noncompliance is corrected. A copy of the management letter will be provided to you at exit, so you will know what the issue is because it is in writing. Finally, for significant items, the findings will be a part of the written audit report. So we call these audit result and comments. This is posted on our website and available to anyone who wants to read your audit report. It is public. The comments will also be provided to you at exit conference. You need to make sure to understand what the problem is and why it is either non-compliance or deficiency in your internal controls. Understanding it means more than the belief that it's only an issue because we said it's an issue. So ask the questions at exit. Even for non-compliance with the uniform compliance guidelines in our manuals or bulletins, we provide our audit position on that, but you need to understand why or how the position affects your ability to achieve your goals, which we will talk about your goals and internal controls later this afternoon. For the report, you may have federal findings. If we do a federal audit, the threshold to trigger a federal audit is $750,000 in federal expenditures within the year. We do the federal audit at the same time that we do the financial and compliance audit. There is a separate report on the results of our federal audit. However, we do issue a supplemental report that puts the written comments and the federal comments in one place. So it's a possibility you could have several reports, and we will talk about those later in this presentation as well. During audits, field examiners will talk to you about any issues that they are seeing. These issues that arise during audit are called comments or findings. The verbiage is interchangeable. So if I say comment or issue or finding, I'm talking about the same thing possibly. It is possible to receive a finding that there is a deficiency in your internal controls over a particular process within financial reporting and accounting. It is also possible to have findings of noncompliance with state statute, local ordinances, or policies, a grant agreement, or the Uniform Accounting and Uniform Compliance Guidelines. Finally, it's possible to have findings on both a control deficiency and noncompliance. By statute, the State Board of Accounts is to establish in writing uniform compliance guidelines. These guidelines are found in our manuals, bulletins, and state examiner directives. A deficiency in internal controls means that the controls are not designed or implemented properly to prevent errors or detect and correct errors. If the deficiency is significant, we are required to report on the deficiency. We do not place an opinion on the internal control system as a whole, which is a different type of audit. However, during the course of an audit, if we note a deficiency in internal controls, we will report on those deficiencies unless they are immaterial or insignificant. If we find noncompliance, there will be a specific statute, uniform compliance guidelines, possible local policy or grant ordinance, grant agreement or ordinance that will be the basis for determining the noncompliance. The specific criteria for the determination for the noncompliance will be part of the finding. So that's kind of how they're set up, and we will talk about how later in this presentation our comments are written so that you can better understand them when you receive them. If the noncompliance is not substantial or impactful to the county, it will not be in a report. Any noncompliance findings have internal control issues. Many noncompliance findings have internal control issues associated with them. So remember that it is possible to have a deficiency in internal controls and not have noncompliance, but it is highly unlikely that you have significant noncompliance without there also being a deficiency in internal controls. They normally go hand in hand. For example, let's say that you may not have any policies or procedures in place to make sure that a task is being completed. But instead, you have this super efficient employee who will always make sure that the task is completed and timely. There would be no noncompliance as the task was always done, but there would be an internal control deficiency because there were no specific procedures established to get the task completed and no monitoring in place to ensure that it was done. So, what is wrong with that? Why would we have a finding at all? I mean, everything is working and the task is always getting done. This question gets to the heart of what we are trying to convey in requiring internal controls. You have an informational system that works most of the time. Why fix it if it's not broken, right? However, some of you have found in the recent past that without internal controls to ensure that the objective is reached, when that informational system is broken, it can cause a lot of extra work and potentially a loss of assets due to misappropriation of theft. But for the sake of the example, let's focus on the unintentional breakdowns. The super efficient employee we're talking about may take a long vacation, they are certainly entitled to it, or go on leave or be off for an illness, injury, or find a newer high-paying job. And now your person is gone. I don't know how many times I've heard the phrase, we were fine, but we lost so and so, and everything fell apart because in the example, the informational process relied on that key individual, and the new employee tasked with the work done, the key employee was lost. Even for a short time, has no processes to follow to get the task done. So the new person doesn't know and may not even know all of the tasks that need to be completed. All the knowledge was in the head of that super efficient employee, which you no longer have access to. And to this, there is no monitoring. So a good deal of time could go by before anyone realizes that the task isn't being complete. You need policies and procedures in place, and you need to monitor the policies are being done and the objectives are being achieved when you have an office full of super efficient employees. As I stated earlier, for significant items, the findings will be a part of the written audit report that is posted to our website and available for anyone who wants to read it. The comments will also be provided to you at exit conference. As an elected official, you will need to understand what the problem is and why it is either noncompliance or deficiency. Understanding it means more. Wait, I just did this one. I did just do that one, right? Hold on. Did it scroll weird? Was that the same one, guys? I was reading my notes but wasn't looking at the slide. Did I already go over this? Oh, I can't hear you, Lori.
I don't think so.
Okay. Okay, I panicked for a minute. Okay, sorry. I apologize. So again, the purpose of the findings. The comments will also be provided to you at exit conference. As an elected official, you need to understand that the problem is and why it is either noncompliance or deficiency in your internal controls. So understanding it means more than the belief, again, that we said so. So ask questions at the exit. If you still feel you have questions after the exit, feel free to contact us and discuss. Again, that's what we're here for. Even for noncompliance with uniform compliance guidelines in our manuals and bulletins, although we are providing our audit position on that, but you need to understand why or how the position affects your ability to achieve your objectives. Like I've said many times, and we'll talk about objectives again this afternoon. You can't resolve the issue unless you understand it. It is possible that in discussing the issue, there may be information the auditor was not aware of that might affect the finding. And when I say auditor in this sense, it's the field examiner. Um, when when taking corrective action, this too often requires establishing or modifying internal controls, which I know you are all excited to talk about this afternoon, so I won't bore you too much with that right now. So, um, since we talked about what findings are and the purpose of the findings, now let's talk about what to expect at exit. Again, I know a lot of you are new and haven't been through an exit conference, so this will kind of give you an idea of what might happen at exit, especially whenever it pertains to repeat comments. There are a few more steps. Um, when your county is audited, you should be notified that if there were any findings, and those findings should be discussed with you prior to exit. Typically, we don't like to just spring a finding or a comment on you that's going to be in the public report because you need to understand what the issue is that was found during audit. There will be a formal exit on those findings to which you will attend. You have the opportunity to discuss the findings at the exit and to submit an official response, which again, I'll talk about a little bit later in this presentation, if you choose to respond in the public report. If there are no written findings and no management letter issued with findings in your office, you should be informed of that as well as part of the audit. So if they didn't find anything, they should tell you that they have no public comments or if they don't have any management letters or verbal comments, etc. Other than the standard formalities at exit, such as introductions, reading of an IC code regarding confidentiality at exit, reviewing the schedule of officials and other paperwork, there are some, to me, when dealing with repeat comments, there are 3 specific things that are pertinent that we should discuss. So the first expectation at exit will be that your lead auditor will discuss the different types of reports that will be issued. Your field examiners will only discuss those types of reports that you will be receiving. So they're not going to tell you about all of them that don't apply to you. These could include, but not limited to, like the financial statements, includes the report of the opinion over the financial statement. The field examiners will discuss the opinions, supplemental compliance reports, which include a transmittal letter, audit results, and comments with official responses, or official response if there is one, and you choose to respond. Compliance management letter, as discussed earlier, addressing noncompliance that does not warrant a comment in the public report, but it's important enough to warrant attention to those in governance. So it's not a public document, but it is written down. And lastly, the internal control management letter, which states any control issues identified as significant deficiencies and or material weaknesses. Again, that's not a public report. Those management letters are just for internal use only. After your lead auditor has explained the differences in reports, they will most likely, if in person, pass out the audit result and comments so that you can view them. Or they could have emailed you prior, and it might say draft on it so that you know what comments they're going to go over at exit. The lead will discuss how the comments are structured, such as having a title, condition, and context, and the criteria, and go through each audit result and comment. They might not read these verbatim because, again, it's expected that they talk to you about the comment prior to exit. So you kind of know what it is, but this is the formal document showing you what your comment will look like in the report. So make sure to ask, this is when you ask questions, and make sure that you understand what the comment is saying. The field staff are the ones that found the issue during the audit. They are the best to explain what they found. So just make sure before you leave exit that you understand, especially if it's a repeat comment, which we're going to talk about next. If it's a repeat comment, this means it's already been in a report before. This is now in a second report, and it's a repeatable comment because it's the same issue that has occurred again. So you have to do a corrective action plan. And you just want to make sure that you understand how to fix it. And that is something that the field examiners can explain how they found it, the processes and procedures that they used, and kind of tell you like possible ways that they've seen it fixed other places, kind of give you ideas. It's important to make sure you understand prior, again, to the exit being over, especially with that repeat comment, because those corrective action plans are submitted to us, which I believe those are my next slides. So whenever a repeat comment is identified, your lead auditor will discuss 1031 repeat comments, which will be provided in a list on the Form 4. So our Form 4 is our exit conference form. Most of the time, when you talk to any of our field staff, they will speak in form number, and that means nothing to you guys. So if you don't know what they're talking about, ask them specifically what the form is. Your lead auditor should provide to you the 1031 packet. This could be printed or sent to you via email prior to exit. Your lead will explain that as a result of IC 511.5 1.5, any repeat finding and comments will need to have a specific corrective action plan and submit it to the State Board of Accounts. So corrective action plans written for repeat comments are not public documents. Corrective action plans are required to be submitted online on our website. And again, I'm going to go through that in a few more slides. So this is one thing that I wanted to touch on prior to moving on to specifically getting into that corrective action plan and those repeat comments. If you have a finding or comment during your audit, which will appear in the public report, an official response is offered. The option of you can answer them at exit if you wish to respond to a comment that is in your public report. You will be asked, so on the form, your lead auditor will ask you during the exit if you wish to respond to any of the reportable comments in the form of a letter to be bound in the report. This is only, again, for those reportable comments that appear in the public report. So if you have a verbal comment or non-compliance management letter comments, these are not reportable comments that will be in the public report. So it's not that you need to respond to those in the official response capacity. So you're only, again, if you don't have a supplemental report, then you don't have any audit result and comments, which means that you don't have any findings or issues to respond to. So no official response is necessary if you don't have any reportable comments. An official response is just a way for an official to respond to a reportable comment and be included in the report for the reader. It is not required, but it is something that is offered. Again, this will be asked of you at exit if you do want to respond officially in that capacity in a written letter. And you just need to tell your lead auditor if you wish to respond or not, and they will document it on their exit forms. So, what I called the presentation was repeat findings. Now we're finally getting there. When discussing repeat findings and comments, there might be findings, comments that are repeats, like we've discussed. These findings and comments have already been identified in a prior audit report. So, in IC 511.5 1.5, this is the statute that discusses repeat findings and corrective action plans. The statute states that in an examination report includes a finding, the finding needs to be corrected. As we discussed, not all findings will be reported in the report. Again, there's different levels. All findings should be reviewed and the need for corrective action addressed. However, for findings in the report, corrective action is for if it is a repeat comment, corrective action is required during the subsequent audit. So if we give you a comment one time, and then the next time we come in, we're going to follow up during that next audit. And we're going to inquire about, is this finding been corrected? Can you show me that it's been corrected? And our field examiners will provide that audit work. So please note that if a finding was reported in the management letter, it will also be reviewed for correction. So just because we follow up on all prior period comments, so those verbal comments, those noncompliance management letter comments, the reportable comments, our field examiners follow up on those, and you want to correct those so it doesn't lead to a bigger issue down the road like we've discussed. So you just want to make sure that the findings are being corrected and you're looking for that action. So if a finding was included in the prior report and you did not take corrective action, or the corrective action is not sufficient, so it didn't fix the problem, and during the audit we find the exact same issue is still occurring, we will include that comment in the subsequent audit report and identify it as a repeat comment. So that's where that repeat comment comes in. Whenever you're looking at the comments in our audit reports, you'll under the title, you'll say this is a repeat comment from prior report, this, with this name, and then it will go into the condition, context, and criteria. So for any findings that are labeled as repeat findings, you will have to develop a written corrective action plan. The corrective action plan applies to findings identified as repeat. You will need to separate a separate plan for each repeat finding. So for example, your report has 3 findings. 2 of them are repeat findings from the previous audit, and 1 of them is a new finding. You will need to provide 2 written corrective action plans, 1 for each repeat finding. So these are, remember again, are listed on the Form 4, stating the number of repeats that you have. You still need to take corrective action on the new finding, but you do not have to submit a corrective action plan in writing. So you need to figure out how to fix it, but it's not something we're requiring to be submitted through our CAP process, our corrective action plan process. At the exit, you will be given that Form 4 and all the required documents for the corrective action plan. The State Board of Accounts will review the corrective action plans and provide any feedback if necessary. So based on the timeline that you provide, and once you have reported the corrective action plan is implemented, we will also follow up with you on the implementation of the plan. If you disagree with a finding, do not believe the corrective action is necessary, we report that to the audit committee, and we will have the opportunity to explain your reasoning. You will have opportunity to explain your reasoning. That could result in a change or a charge or clarification to statute. Remember that the corrective action plan is not the same as your official response. So these are 2 separate things. The corrective action plan will not be part of the report. While you can have an official response be a part of your report, your corrective action plan is completely separate. If you do complete a corrective action plan, again, we'll follow up with you on your progress of the plan and see if it has been corrected within the timeline. So it's important to understand the findings that you have. And we've talked about this. At exit, make sure that you understand what's going on. Um, as, and so you can correct a problem if you don't see it as you can't correct it if you don't see it as a problem. So again, understanding why is so very important. Ask questions of your field examiners. They're the best ones to tell you what's happening. If you're told that there are significant deficiencies in internal controls, ask what those deficiencies are and what potential noncompliance could result from those deficiencies. If the issue is noncompliance, the problem should be related to specific criteria in the comment that you're given. Information taken from our uniform compliance guidelines, such as like our manuals, bulletins, directives, local policies, ordinances, or requirements from a grant agreement for federal or state grants. The second step is to fully understand why the issue or problem occurred. Ask yourself why, or brainstorm with others on the why. This could be something where maybe it's not a job that you do specifically, but someone else does in your office. Figure out the steps and processes and procedures, which we're going to talk more about internal controls this afternoon and how to assess the risk and monitor your controls. So this can kind of help with the why. Because you need to figure out why it's happening and the root cause. So once you have reached the why and you understand why, you can start on your corrective action plan. In this case, in this case, the power of why is so incredibly important because you can't effectively create a corrective action plan if you don't know why. So I know that I feel like I'm beating this to death, but please understand your findings and why and how you can correct them because you don't want to have the same comment appear continuously. So now the elusive corrective action plan that I have been referring to for 15 slides now. If you have a repeat finding in the report, at your exit conference, again, you're going to be given that packet. The packet includes a form that lists each repeat finding for which you will need a corrective action plan to be filed on our website, which I'll provide the link to you later in the resources. You will also be given instructions on completing the form. So if you've never done this before, again, field staff can help you. We can show you the instructions. We give you those in the packet. We can help you navigate to where it is on the website. There will be also additional information on the process, definitions, and some frequently asked questions in the packet that you are provided. The field examiner should discuss some potential corrective action that could be taken. Again, use them as a resource. These potential corrective actions are not mandatory procedures, but will hopefully give you some insight into what you need to do to fix the issue. You do have 10 days after the exit conference to upload your corrective action plan. Or you can contact us via email in the packet that's provided to you. You can request an extension of time to provide the corrective action plan. You have 6 months to fully implement the corrective action. However, some issues might take longer to fully fix. So if for some reason 6 months is not long enough, you can contact us and we can be like, okay, how long do you need to fix the problem? Again, we are monitoring the progress and the implementation of the corrective action plan. So we can see that it has been corrected. Like I said, Ops will review these. So Ops is a department within the State Board of Accounts, and they will review the corrective action plans for the counties once you have submitted them on our website. If you have any questions or feel more, or if you need more information, contact us or contact your field staff. We can help you complete the corrective action, or if for some reason ops has deemed that maybe this isn't a proper corrective action, then what can we do to fix that? How can we make a plan so that your comment will no longer be a repeat? Once approved, you will be notified that the plan is acceptable and reminded that you are required to notify us when the implementation is complete. We will follow up either by reviewing documentation that you send into us or by having someone visit you at your office to review the implementation of the corrective action plan. So it could either be done virtually or on site. It just kind of depends on the issue and the corrective action taken. I just wanted to kind of show you what it looks like. I know I've been talking at length about repeat comments and findings, but the corrective action plan isn't that scary. This is all that you're required to complete and fill out on our website. It details the report period, title of the resultant comments, contact person responsible for the corrective action. So who will be making sure that it's implemented? The contact person's name, email, views of responsible official, description of the corrective action plan, anticipated completion date, and then lastly, the last section of that cap is, if applicable, document reasons why you cannot correct within 6 months. So if, again, you need longer, just let us know and fill that out there. Okay, so now I'm gonna kind of get away from, okay, what is this? What is this? What is this? We want to talk about the repeat comment trends that we are seeing. So whenever we talk about repeat comments, there's been enough time go by now that enough audit cycles that we can see that there are repeat comments that are most common. And I kind of put in that I've listed them in order from like most significant to least. So internal controls over financial transactions and reporting, 24%, capital assets, 13%, financial transactions and reporting, 11%, bank account reconciliations, 10, certification, adoption, and training on internal control standards, 7%, MVH restricted, 5%, annual financial report, and overdrawn cash balances were both 3%. I'm not going to talk about the other repeat comments because those are most of the time a one-off. So I'm going to save those to talk about in person and kind of go through those because those are more specific. But these are trends that we're seeing where these are the most common things, and these issues continue to happen and occur, and these are the most corrective action plans that we're seeing. So let's go over them individually. For the most common repeat findings, internal controls over financial transactions and reporting, and there's also financial transactions and reporting. I've decided to combine these two categories together and go over, since majority of the time these issues have similar criteria depending on if it was a deficiency in internal controls or if it was regarding non-compliance. The most common issues that we're seeing are internal control deficiencies over cash investments, receipts, disbursements, financial close and reporting. Majority of the time, there is no segregation of duties over these areas, and one person is doing it all. We will go over internal controls in depthly again this afternoon, so I'm not going to get into that right now. So I don't want to spoil the fun for you. I know that you're all like, oh, fun. Yes, I understand. As we have discussed in this presentation, it's important to understand the finding and prepare the corrective action plan. So I wanted to provide some things to think about. So if maybe this is a repeat comment that your county has, these might be some questions to ask because maybe you don't understand why it's a repeat comment. So these are just some things to think about. How was the deficiency found? This is something that your field staff can provide. What was the situation? So this is something you can ask at exit or whenever they're there and they find it, because they should be bringing it to you. How did they find it? Because it might not be something you thought of. What is the likeliness of this happening again? This is something to consider for a risk assessment standpoint, which again, I know you guys are going to be excited. We're going to talk about this afternoon. You need to understand that this could be a one-time occurrence, or this could be happening more frequently. You just might not know that it's happening. And it could be because of a deficiency or weakness in internal controls. With that weakness, fraud could easily occur. So this is something that you just need to think about. Do you need to update your internal control procedures? Are you monitoring your internal controls? I know you're excited. We'll talk about that later too. I know you're all chuckling. You're so excited. Most likely, if a deficiency was noted during the audit, this will signal, monitoring activities will signal that you need to review your internal control procedures. If you can identify what was wrong, this will allow you to then see where in the process the deficiency occurred. So you just want to make sure that you have monitoring activities implemented. And then again, like I noted, is there segregation of duties? Is one This is the most common issue, is you have that one efficient employee doing everything. Can the control be viewed during the audit? Can you see that there are multiple people involved in the process? That's when you just need to remember to document, 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 that I know you'll hear me say again this afternoon. So again, those are internal controls over financial close and report, our transactions and reporting. Let's talk about capital assets. So for capital assets, this comes directly from Chapter 1 of our Uniform Compliance Guidelines, where it details out that you need to have a capital asset policy, that you need to establish a threshold, that you need to maintain a complete detailed listing of all assets owned and reflects their acquisition value. It tells you use the Form 369 that's been prescribed for this purpose of tracking capital assets. A complete inventory must be taken at least every 2 years, unless your county has implemented more stringent requirements. And so you might be doing, instead of every 2 years, you're doing inventory every year. So it's kind of up to the county how frequently they're inventorying those assets. Um, so what I just talked about, again, that comes from our uniform compliance guidelines and tells you what you need to have. So some things to think about to correct this capital asset problem is, do you have a capital asset policy? Has a capital asset threshold been set? Have you established that? Are you keeping track of additions and reductions to capital assets? You need this information for the annual financial report. So are you keeping track of it? Are you keeping a complete detailed listing of assets? So does it have the value in which you purchased it for listed on there, or are items missing? Are you performing a complete physical inventory at least every 2 years, or if it is more stringent, um, is it every year or whatever your policy states? Is this information retained for audit? So you just want to make sure that you're thinking of these things to try and fix the problem. So the capital assets, it's like, oh, this could maybe easily be fixed. Maybe there was a deficiency in the process that you have set up for inventorying or for adding assets. So it's just something to think about. I don't know how many times I've been on site and, oh, we don't know where our capital assets list is. And that's like the worst thing that you could tell a field examiner. They're like, you don't have the list. And then they slowly go, oh, and they look sad because that's just a lot more work. And again, we're not here to nitpick on every little thing. So capital assets is something that can easily be corrected so that you don't have that comment again and again. Bank account reconcilements. I'm not going to spend too much on this. This common comment is for the county treasurers. So I'm not going to really, I'm going to go over the slide, but not talk about it in depthly because the reconcilement between the auditor and treasurer is included in our other percentage. So I'm going to go through that in person, but this is more regarding, you know, are you preparing bank reconcilements monthly for all depository accounts? Are your bank account reconciliations accurate? Are you comparing the adjusted bank balance to the ending fund balance? Is there a variance? Have you identified all reconciling items? Were there any adjustments? Why? Again, this is mostly for treasurers. The reconcilement between auditor and treasurer is noted in other. So we'll go into that a little bit more in depthly when we're in person. Um, a newer comment that has been extremely common is the certification, adoption, and training on internal control standards. So this is in regards to IC 511-127, Section G. Um, it states that internal control standards and procedures developed under this subsection are adopted by the political subdivision, and personnel receive training concerning the internal control standards and procedures adopted by the political subdivision. So, with that statute in mind, there are some things that you can easily think about to maybe correct this. Did your county adopt an adopt internal control policies and procedures? Do you know where the adopted internal control policy is that you adopted? Like, can you actually find that document? Um, did you do the required training provided by State Board of Accounts? I believe this training is on our YouTube channel. It's 27-minute video. Did you somehow keep track of the certifications that you watched those videos, or who did? So did you retain that documentation that all required personnel who handle cash have watched that required training? Again, this might be something where your county might differ. Depending on the policies in place, you might require that all personnel watch the training video and certify yearly, or you might require that only individuals that actually handle cash need to watch the video and certify. This is all dependent on county policies. So that one is kind of like who watches it, or if everybody's watching it. That's kind of county dependent. Did you certify correctly on Gateway? So this is one that I feel like a lot of counties are kind of getting dinged with, because when it comes to Gateway, there's several questions on the unit questions asking specifically if you have adopted the minimum level of internal control standards as required by IC 511-127E, and if personnel received training concerning internal control standards adopted by the unit. So these are two little boxes that you check yes or no. So you need to think about when you answer these questions on Gateway that you answer them correctly. That's where that issue is coming from. It's because maybe you didn't make sure that everyone received that internal control training, and you said yes, all personnel receive the proper training, and when we come into audit, that person maybe someone didn't, who handles cash every single day. So again, all of the information, like, these are just some of the questions you can ask, and it might be different from county to county what the actual comment states concerning this comment, because there are a lot of moving pieces to it. A few things to keep in mind with NVH restricted subfund, which was introduced in 2018. While the subfund is part of the NVH fund as a whole, it should not have a negative balance at the end of the year. This is something that we're seeing. The county is required to deposit at least 50% of the NVH distributions into the NVH restricted subfund, and can only be used to pay for construction, reconstruction, and preservation. Remember that the NVH fund 1176 can also be used to pay for construction, reconstruction, and preservation costs. If there are costs that exceed the revenue in the NVH restricted subfund 1173, the cost should then be posted to the 1176 fund. And I just wanted to mention this because that's one of the issues that we were seeing. This should be monitored throughout the year so that neither of these funds go negative. Again, that's something that we're seeing pretty frequently. If expenses posted to NVH restricted cause it to have a negative balances, those expenses can be moved to 1176. Remember that no transfer of funds from 1176 to 1173 should be occurring without an ordinance or resolution allocating monies in excess of 50%. So that's, again, something that we're seeing. So some things to think about. Was a subfund for NVH restricted created? Is Fund 1173 reported separately on the AFR? Did the county deposit at least 50% of the NVH distributions into the NVH restricted subfund? Were the funds used exclusively for construction, reconstruction, and preservation of the county highways? Again, this is something that we are seeing commonly, so some things to think about. We're almost done, I promise. I'm keeping you from lunch. So again, in our Uniform Compliance Guidelines, Chapter 1, We talk about overdrawn cash balance. The cash balance of any fund may not be reduced below zero. Routinely overdrawn funds could be an indicator of serious financial problems, which should be investigated by the unit. In an instance in which a unit receives a reimbursement grant, the unit must be claiming reimbursement in a timely manner. And in this case, it would be possible for a fund to be overdrawn for a short period of time. So that comes directly from our uniform compliance guidelines. So whenever it comes to these overdrawn cash balance repeat comments that we're seeing, let's think about, at year end, do you have a fund that was negative? Did you review your funds ledger to see if there's any negative balances? Did you investigate why is the fund negative? Is it a grant fund? Did you look into it? Because that's going to be something that your field examiners, will ask you during audit. What happened during the year? Maybe think about what happened so that whenever the field staff ask and they need to write a note to the financial statements, they have an explanation to put in the note as to why the fund was overdrawn. Again, is the fund a grant fund? Um, is it a reimbursement grant? Just some things to think about because your field staff will ask you about it. I believe this is my last one to go through. So annual financial reports. These comments vary because it kind of is, there could be late submission of the annual financial report. There could be errors, inaccurate information. So this comment kind of reaches an array of things. So I'm just going to jump into what are some things to think about? Was the AFR submitted timely by the deadline? It's imperative that the annual financial report be submitted by the deadline, which, as statute states, is 60 days after the close of each fiscal year. We use the information to run your financial statements that we use during the audit. So without that information, we don't have financial statements. So we really need that information entered, and we need it to be accurate. Did the AFR include accurate information? Did the annual financial report include any financial transactions, financial transactions for the calendar year? You just want to make sure that it's accurate. You want to have inclusion of all financial information. We can make adjustments during audit, but it kind of just slows down the audit process. So the closer you can get it to perfect, that's preferable. That, it makes your audit go by a lot quicker. Were all component unit financial information included? Were all investments included? Debt, grants? Again, this kind of goes back to the accuracy of information. You want to make sure that we use this information for your financials. So you want to make sure that this information's entered because again, if you don't enter your grant information and you receive federal funds during that year and we set you up for a non-federal audit, you maybe have a federal audit that needs to be completed. So it's very important that this information is accurate, especially with debt and federal grants. We can't stress that enough. I wanted to include all the resources because I know I'm like 1 minute from lunch and I don't want anyone to send any hate messages through the chat. So here's all the State Board of Accounts resources. I've included links for CAPS, uniform compliance guidelines in our resource library. Again, if you have any questions, contact us. So, Ricky?
Oh, okay. Good job. All right. Well, it is just at noon, so we're going to go ahead and break for lunch. We'll start back up again at 1 o'clock with the ever interesting new legislation from Lori Rogers. I do want to let you know that I am not going to disconnect the WebEx. We're going to leave it live and going as it is. I'm afraid there'd be connection issues if we do that. So you can you should be able to feel free to exit and come back as we're going to leave it all open. And enjoy your 1 hour lunch, and we'll see you guys back here in an hour. I am turning my video off, just so you know. All right, Lori, say something. Make sure you're working.
Something.
Something works.
Okay.
We need to flag that.
Ricky, I have the little red thing. Does that mean I have control, or do you take that back? Or am I sharing?
Nope, I
Okay.
have it now.
Oh, okay.
Sorry. I forgot you still had it.
That's okay. I don't remember if at the end I was able to stop. I couldn't figure it out for a minute.
Wonder if I could open my window now. Is that too much light? It is, isn't it?
It's not horrible. You're not washed out or anything.
I was hoping you'd be able to see the. Oh, I guess you can.
Hmm.
See the State House right behind me there. And I can step closer to the camera. We have about a minute of lunch left, and then we will get started promptly at 1, guys. Okay,
Am I
Lauren,
sharing the right screen?
you are sharing the right screen. It is all yours.
Cool. I think. I lost mine though.
Just so you know, Tony
Yeah.
says, if you can't see us, I'll just continue eating.
Go right ahead, Tony. Enjoy. Okay, I'm going to get started because we have a lot to go over. I don't want to run into the next time. We should not have put new legislation immediately after lunch because it's going to put you all to sleep. So keep eating and maybe you'll stay awake long enough. There was a lot. It was a longer session. There was a lot in the legislation. So I have some caveats before we begin. Some of these bills are pretty deep, and we're going to have to be brainstorming and digesting them to figure out the guidance we're going to give on those. So there's going to be future guidance coming out on some of these. So I'm just going to go over an overview that the bill exists and then we're going to have to work on how it's going to be implemented. And the second thing is I did include some of the bills that have to do with changes in assessing and tax billing. But I'm almost positive DLGF will be doing either a webinar in June. I think that's what they did last year, and they'll do a series of memos to explain them to give you more guidance because there's a lot of calculations in those. I just wanted to let you know where they were, and I'll point those out as we go through. So the first one is one of the bigger ones. So basically, we've overhauled a public health funding. You know, traditionally, you have your Fund 1159, which is your local health fund. It is a tax levy that you establish at the county level, and those tax receipts, those tax revenues get put in there every settlement. That fund is continuing. You will still have a tax levy. That health fund continues to be used the way it has been used. Okay. The only change they made into it, which I'm not sure why, but they specifically put in it that the fund is non-reverting, but it was always non-reverting. We did not take the balance back to the general fund, but now it specifically states that. Then you had two other funds that you were using. The first one was the 1168, the Local Health Maintenance Fund, and then Fund 1206. Some counties got, some counties didn't, and that's the Local Health Trust Account. The state is no longer funding those the way they used to. So they repealed all of the language that determined how much money went through the local health maintenance and how the trust money was delivered. So those funds in the manner that they are will cease to exist. We know there are balances in those funds, and that's something we're going to have to figure out guidance on to determine how to tell you to go forward with the balance still in those funds. There'll be a new fund established. That new fund, again, we'll come up with a fund number if we reuse one of the others, is going to be called a public health services fund, and that is going to hold the money that comes from the state. So instead of two funds that had money coming from the state, there'll just be the one now. Okay. And like I said, there's going to be a lot more we're going to have to work on to get how we get all of that implemented. So Senate Bill 4 was that public health bill, and there's quite a bit. I would encourage you to read it. There's quite a bit of information in it. It now has a section that defines core public health services, and this is important in determining how much funding your county is asking for. So it's really going to be the Board of Health that's going to be on top of that, but just that you're aware that there is core public health services, and that affects your funding. It does provide new requirements for a local health officer and the kind of training that person has to have. There's still an annual report. The health department has always had to provide an annual report that they then issued in a pamphlet form, held out. Now they're going to submit that to the Indiana Department of Health, and it's going to be published at the state level. They're going to aggregate all the information together. Okay, and as I said, the whole funding scheme has changed, and we'll be working on that. There's basically going to be two ways the county can receive funding. The first is more of an advanced funding. If you agree to this, and the county has to agree to this, so your commissioners would make a formal agreement to do this, it requires more work on your part. You get a higher level of funding, but you have to provide your services in a certain way. Like 60% of the core services are the individual services, and only 40% can be spent on things like, septic systems and restaurant inspections and things like that. You have to apply. I can't remember everything that you have to do now, but there's a lot involved in what you have to. You have to do a maintenance of effort, which we kind of talked about in the federal, so that you have to keep the level of funding in your public health fund, which is that tax levy fund. That fund has to stay. You can't take more state fund and then reduce your tax levy. So they're going to be looking at that. So there's going to be a maintenance of effort part of it. There's going to be an annual report that you're going to have to get that tells what you're using the money for. They're going to be watching it a little more closely. So again, it's more work. If you choose not to go with the expanded one or the additional funding, you will continue to receive funding, but you will receive it at the level that your county received in 2023 for the local health maintenance and that local trust. Whatever that was, is kind of going to be frozen at that until the law changes, and that's what you're going to receive each year. You still do have some reporting requirements with that. You don't have the additional maintenance of effort. And again, there's a lot of information in this. We're going to have to work through it, including what we're going to do with those existing balances, there's a lot of decisions made. The statute doesn't tell you what to do with those balances. So whether they can be moved into the new fund or whether they need to be used to finish out any programs you had under the old funding, we're going to have to make that determination and get back to you on that one. So look for more information on that. If your county has a city health department, the funding that you receive from the state, you have to share then with that city health department. And there was a formula within the statute that tells you how to do that. It also makes it that after this year, after this bill passes, which is July 1st, you cannot establish new city health departments. So the ones that exist can continue to exist. They're grandfathered in, but no new city health departments can. It will all be on the county. There's also information on joint. If you're working together as a multi-county board of health, there's some additional information on that. So again, it's a long and fairly deep statute, and you're going to want to know about that. There are several bills that passed this year. This is one that DLGF will be going over for you, I'm sure, because as you're probably well aware, and as your citizens are well aware, a lot of tax bills went up because of the market, because of trending. There are some this is one where it's a county option to give a certain circuit breaker tax credit to qualified individuals. To be a qualified individual is someone who has a homestead deduction on his property, has lived on the property for at least 10 years, is at least 55 years of age, not receiving the over 65 credit, they can't get both, and meets the income guidelines that will be your county will specify in their county ordinance. The credit is only allowed for 2 years through I'm not for 2 years. This one is not. The credit is only allowed through taxes 26 pay 27. So there is an ending to it, but it does allow a brief respite from the a credit from the increased taxes. And again, DLGF will go over the calculations and how you're going to implement that. This has to deal with the Elected Officers Training Fund. I mean, there's been a lot of discussion on that. The biggest thing with it is if your council makes a determination that there is sufficient money in the fund to fund what is needed for the training for the officers that it relates to, and so the statute relates to auditors, treasurers, recorders, clerks, and surveyors. Those are the ones that are specifically listed in the statute to use this money for to meet their continuing professional education training. If it's determined that there is sufficient money to do that and that there's excess money above that, they will now authorize the auditor to transfer that excess to the recorder's record perpetuation fund. So one time only. You do it before the end of the year, or you don't do it at all. So just so you're aware of that, again, that determination would have to be made first. And that's really what we would be looking for, is that they actually looked at that determination and determined that there was an excess. Kind of in the same lines, other than the excess, if they are upon determination, determine there is sufficient money to meet the statutory purpose of the fund, which is to pay for that continuing professional education for auditors, treasurers, recorders, clerks, and surveyors. Council members can now also be added to use the funding to pay for their training, but they have to, the training of the original officers have to be at first before the council would. This really only affects Lake County and St. Joseph County because of the way they're structured. And it does move some of the responsibilities that were under the legislative body, which was the council, back to the executive, or changed back to the executive. So again, it's very specific to those two counties, and it has to do with the purchasing agency and the processing, data processing. Both of those are now going to be under the executive branch instead of the legislative branch. This is another one you're probably going to receive a memo or training from DLGF, but it affects tax sales. So that is in the code, in Indiana Code 61.1-24, which the whole chapter deals with tax sales. And there is a form that the auditor keeps, which is a tax sale record. We have a prescribed form. You probably are using something automated at this point or through your software. What this bill provides going forward is that it adds additional restrictions for purchasers of property. When they get that tax sale certificate, they cannot transfer that to someone who would not have been eligible to bid on the property in the first place. So you have those 3 sections in 61.124 that lists the ineligible bidders, goes through all of the ones that are not allowed to participate in a tax sale. What this does is say, even if someone that was not on that list makes a purchase, they cannot transfer that tax sale certificate to someone that would not be eligible. So it puts some safeguards in place to make sure that that isn't happening. So you get a signed statement from the bidder before the sale that they understand that. They're not going into that for that purpose. There are restrictions on when that assigning of the certificate is actually valid, and that requires the approval of the county auditor to say, yes, this is an eligible bidder, would have been an eligible bidder, you can transfer this certificate of sale to that person. They then the auditor will need to document that on the tax sale record, that the assignment has changed, and then a copy of that tax sale record must be included with the petition for tax deed. And then within 15 days after the sale, that has to be made available on your website so that it's open to the public. This is to handle, again, this is in 61.1-24, which is the tax sale property or chapter. And this is for property that has been offered more than once, either at a treasurer's tax sale or at a tax sale certificate by the executive or a combination thereof. It's been offered up for sale more than once and no bid has been made on it. And your executive has made or has agreed to pass an ordinance to this effect. Nope, that's a later one. I'm sorry. I'm getting these confused in my head. This also prohibits a person from who owns property that's been offered for by sale, who has had a property in a tax sale that is not purchased. They are now ineligible bidders at the tax sale itself. So if they have property that's been offered for sale because they have not paid their delinquent taxes, they cannot bid on new property. And the properties that have not been sold after being offered for 2 or more bids can be declared a public hazard if the county has adopted an ordinance to that effect. And there's details in there on how that ordinance has to read, what has to be in that. And by making it, the court can order it then to become a public hazard. And then there's certain things that you can do with it, including transferring it to municipality to take over to ameliorate any hazards that are on it or to do what they need to do to make it usable property again. They recently, I think it was 2 years ago, they completely repealed and reissued the chapter on unclaimed property to the Attorney General. And so these are some corrections to that. One thing they added was a definition of gift cards and when those can be presumed to be abandoned. They also changed property held by the court to 3 years. It was 5 years, and then when they repealed the statute and reissued it, they said 1 year, and now they're changing it to 3 years. So courts can hold property for 3 years before it's be considered abandoned and have to be returned or submitted to the Attorney General. And it also has some technical changes in there. You can no longer submit a report other than electronically to the Attorney General. So the instructions are on the website for that. There's another one on the sale of tax delinquent property, and this involves property that has a severed interest, and that is an improvement, mineral right, air right, water right, or other rights on the property that are on, under, or above the land for which the owner or holder of that interest is identified in the current real property tax records of the county auditor as a separate property tax statement. So this is just severing, saying that if they are not paying their taxes and the portion that is the severed interest is sold, it does not affect the rights, the lease that was originally on the land. Excuse me, as long as that lease was part of a public record. (36-1-8.5-2) addresses address confidentiality. And again, this is like for your, probably the biggest one is your property tax database. So if there's any database that you keep that someone can go in, they don't have to have a user ID, they don't have to have a password, they can just go in on an internet site, pull up an address or pull up a name and find out their property records. There are people that are covered persons that can request that their information be redacted so that you cannot get their information that way. And so we've talked about this in the past, and there's quite a list: judges, law enforcement officers, probation officers, down through there's several of that. They used to have or formerly had listed a victim of domestic violence, and all they've done is change that, I guess, to a more correct title to call it an address confidentiality program participant. And those are certified by the Attorney General if someone meets that definition, and then their information has to be prevented to be accessible on that public website. Okay, this is another big one that we're going to have to get you some additional information on it as soon as we get it digested and sit down with all the directors and our legal staff and figure out how to go forward. Ricky talked this morning about Indiana Code 511.10 1.6, which is the statute that says what you have to have in order to pay a claim, and I'm sure you're all familiar with it. So that does include a fully itemized invoice or bill, approval by the official or person receiving the goods and services, that the claim is filed with the fiscal officer, that the fiscal officer has audited and certified the claim, that it's true and correct, and that the payment is allowed or approved by the governing board having jurisdiction over the payment of claims. So our uniform compliance guidance has always been, and it still is, although the law has changed, you should not be paying claims in advance of the receipt of goods or services. And of course that complies with the statute, because how can you certify you've received it if you pay it in advance? We had one exception formally to this, and that was in for counties, that was in 36.264.5. And that's the statute that allows for the prepayment of the claim in advance of the board approval. So those are that list that you can do, like utility bills and credit cards and things that are due in a short period of time, that your ordinance says you can pay these and then just submit them at the next commissioners meeting for them to look over, but you don't need their approval prior to paying them. What Senate Bill 317 does is have a further modification to 511.10 1.6. It allows for 4 times where you can pay the bill before you receive the goods or services. The first one relates to schools only. I'm not going to go over that. And the second one relates to meal expenses for a municipality, a city, or a town when they have someone in travel status. But the third and fourth do apply to counties. The third one is outlined on this slide, and it has to deal with public works projects. So when there's a public works project and the county chooses the unit, in this case the county would choose to do so, they can make advance payments to the contractors for the specific purpose of allowing that contractor to purchase supplies and materials needed to complete the unit's project, that public works project. To do this, the solicitation for the bids for the public works projects must include that the political subdivision will make advance payments to contractors to enable the purchase of materials. That's got to be part of so everyone's aware of it, part of the solicitation for bids. Any limitations on the amount of the advance payment that will be made, requirements for documentation relating to making these advance payments to contractors for materials, and then any other information that about advance payments for materials that the county considers useful to the contractors. They need to have all of that up front in that request for bids that goes out. As we said, the guidance to not allow prepayments except as authorized by statute is to protect the political subdivision from paying for goods and services that they actually never receive. So in allowing for prepayment of materials, the unit needs to determine that that is the best route to take and make sure that there are requirements that substantiate that the materials were purchased for the unit's project only, were used on the unit's project. You want to make sure you're getting what you paid for. For example, if you prepay $100,000 for materials, you want something subsequently to document that $100,000 was based on materials that were then used in your project. So your concern is that the county comes out ahead, not that the cash flow problem of the contractor is taken care of. You want to protect the county in all of this. And again, we'll probably, as we talk about this, figure out if there's more guidance that we can give on that. Okay, I think I moved ahead accidentally. The second one is on goods and services. Okay, the first one was public works. This is public purchases. Okay. In this case, the fiscal body must authorize making the advance payment. So it comes through county council. The prepayments have to be tracked by use of defining the prepayment on a purchase order. You're going to have to use a purchase order system so you can track these payments. The prepayment invoice It has to be created, so you still have to have a detailed invoice that's associated with this purchase order. Okay, and you need to do an insurance or surety bond in the amount of the prepayment that is required if the prepayment is more than $150,000. Again, you want to make sure the county is receiving the goods and service it pays for. So if your council approves making a prepayment, you're going to need to establish controls with procedures and policies in place. I say you, the county, because your commissioners are going to have to be involved in this as well as the council, with policies and procedures that govern how you will track from prepayment to receipt of the goods and services and making any final payment due, and that all of that is documented and posted properly. This will require the use of purchase orders, invoices, as we've said, and then a follow-up. You're going to have to at some point get that certification that the goods and services were received before making any final payment. So the example that comes up really isn't a county, although it might if a highway department had a big piece of equipment. But the example I came up with is that it's come up for small towns that they want to purchase a fire truck, but the manufacturer won't even start building that fire truck until they have half of the cost paid up front by the unit. So they would need to get an invoice for the total cost with how much is required prepayment, attach that to a purchase order that then is approved by their governing board. So the cost is still being approved by the governing board. And again, this is after the council has already approved their ability to do this, to do a prepayment. The prepayment would be sent out through the claims process. When the truck is received, you'll have another claim that's completed for the final payment and a copy of the purchase order and invoice and attached to show the complete transaction and the amount prepaid. For prepayments that are associated with public works, which we talked about first, or public purchases, like our fire truck example, you cannot pay more than 50% of the entire cost, and the final limit is $2 million. And again, we're going to have to work with some more guidance on making sure we have procedures in place, or how you determine those procedures. We'll have to relook. We do have a purchase order form. It's Form 98. We may probably have to modify that to allow for documentation of any prepayments. And this is another one that I'm sure you're going to be getting information from DLGF on. I believe there was, I'm not the expert on this, so I'm glad DLGF will be doing that. But this bill, I think, is a result of a lawsuit that happened in Indianapolis, and it clarifies what is considered homestead property for purposes of applying the homestead deduction. So the definition for homestead is found in 6.1.11237, and they've modified that now to put the definition in there in one concise place. It is residential real property improvements that an individual uses as the individual's residence, limited to a single house and a single garage, regardless of whether that single garage is attached or detached. The homestead includes up to 1 acre of land immediately surrounding that dwelling, and any of the following improvements: any number of decks, patios, gazebos, or pools, one additional building that is not part of the dwelling if the building is used predominantly for a residential purpose and is not used as an investment property as a rental property, and one additional residential yard structure other than a deck, patio, gazebo, or pool. So I'm sure that's really clear. And again, you're going to probably get additional guidance on that. It also defines non-residential property for applying the circuit breaker credits to those, or circuit breaker limits to those. And for non-residential property is real property that is not a homestead. It is residential property, long-term care facility, or agricultural land. This is more informational only, and I'm not going to spend a lot of time on this, but it does allow Department of Natural Resource to create an affidavit when there's a violation for a deficiency in one of their enforcements. They can attach that deficiency to a deed. So you just need to you may get questions about it. It's not something you'll really have to deal with. The recorder will record it and release it once the reparations have been made, but in case someone asks about it, you'll just know that it's there or what it is. Go backwards instead of forwards. I think I did. Okay. Okay. Senate Bill 417 allows the county fiscal body to adopt an ordinance that imposes a tax rate. So this is a local income tax rate for county staff expenses of the state judicial system or your courts. The tax rate must be in increments of 0.01% and may not exceed 0.2% and cannot be in effect for more than 25 years. The revenue that's generated from this tax rate must be distributed directly to the county before the remainder of the expenditure rate would be distributed. It will be deposited to a separate fund, and we'll be giving you a fund number on that if your county chooses to go with that. And it can only be used to pay for county staff expenses. This is not supplies or anything. This is just personal expenses and benefits. The local income tax revenue may not compromise more than 50% of the county's total budgeted operational staffing expenses. So you can only meet 50% of your budgeted needs. And the rest is still going to have to come from your property tax. If you choose to do this, you will have to annually report by May 1st of each year to the Justice Reinvestment Advisory Board on the type of the court positions paid, the number of court positions paid, the average salary by type of court position paid by the income tax, and the county's total budget and actual staffing expenses related to the judicial system. And the report will show what portion of LIT was budgeted and actually spent. I think they're gathering that information, and there's been a lot of talk about, which you're well aware of, the court is a separate judicial circuit. It's not part of the county. It's just funded by the county. And this is one way I think they're looking at that and then finding a way for counties to be able to pay for part of those costs. The budget bill is always a very long bill. And towards the end of it, a lot things get added. These are just some highlights of what's in there that affect counties. They did make some changes to the opioid settlement distributions. They're planning to make a minimum of 2 payments per year. Any distribution after June 30th, 2023, that is less than $5,000 will go directly to the county. It's stating in there that all entities receiving opioid settlement funds must provide an annual report to FSSA. We still don't know if that's on restricted or unrestricted in both. That's why we have you set up 2 separate funds so that if they do require a report on all of the funding, you've got that information in those funds so that you can do that. A city, town, or county may transfer all or part of their distribution to another city, town, or county so that you use for the benefit of both communities. So you can do like an interlocal agreement where you're using the money together to fund one particular, project or several projects that hit both your counties. Also, upon the majority vote of a legislative body, a city, county, or town may sell for cash the right to receive the distribution. So you're giving up your future payments for an upfront cash payment now, if you want to work that out. But the funds received, even from the sale, must still be used for the purposes allowed. So if you're a small town and you're only getting a small amount, you could get upfront cash, say from a county, that would then get your distributions going forward. And then you would have cash up front maybe to do a bigger project. There have been some changes, and I think they're just really technical corrections. So the certificate of settlement and statement of distribution that goes to DLGF, that's going to be, I missed that on the last one. Maybe I did it. Yes, I'm sorry. The abstract is going to be delivered to DLGF, not to the Auditor State. It's going to be on Gateway. It's the way you've been doing it. They were going to shift that over to the Auditor State's office, but I think DLGF is just going to keep the responsibility for that, that application on Gateway. And then the auditor of state will give the certificate of settlement distribution back to DLGF so that they can validate those abstracts. So that's going to complete the cycle. Then DLGF will also provide an annual report of property tax data by counties and publish that report no later than December 31st of each year. So it's going to be aggregate of all of the counties. In the future, Department of Local Government Finance will assist in calculating the percentages for your property tax replacement credit. And this is the last one is on this slide is on the funding for your misdemeanor fund. And I don't know if you've ever looked at it, but formerly there used to be a allocation amount by county. So you went through and each county had a specific allocation amount in the budget. They've removed that, repealed that, but they've replaced it with a multiplier. For each county is assigned a multiplier. So if you want to know how much your misdemeanor fund is going to get, you need to look at what the total appropriation for the misdemeanor fund for counties is in the budget, then take your county's multiplier by that, and it'll tell you what percentage you're going to get. This goes back to the one we talked about earlier about if your county has a city health department. And again, you have to distribute, the funding will come from the state to the county, and the county is going to have to distribute to those city health departments. And so this in the budget bill, they added that you will have to do an interlocal agreement so that it covers how that distribution is going to work. And the distribution should be within 5 days of when county receives the money. They should get the city their share. There is going to be a change coming up for tax revenue collected after June 30th, 2024 for a tax levy that's imposed under Indiana Code 20-46-8. That's the schools, and that's an operation levy. And so if a school revenue that's collected under an operation levy after June 30th, 2024 is going to have to be distributed to eligible charter schools starting in 2025, and you're going to have to get further instruction on how it's determined between, I think, DLGF and DOE, how they determine how much needs to go to the charter schools. And then more specifically, for charter schools in Lake Marion, St. Joe, and Vanderburgh, they have a specific calculation. $1040 was the State Board of Accounts bill, and I'm sure there's been some talk about this. So it amended our code, which is Indiana Code 511.1. And it sets in a definition that if for an inaudible unit, well, not a definition, sets up a requirement for an inaudible unit. So if we come into audit and we are not able to audit because the entity's accounts, records, files, or reports are not properly maintained or reconciled, the audit entity may be declared to be unauditable. And audited entity that is declared unauditable shall bring its accounts, records, or files or reports to an auditable condition within 90 days. Okay. And the State Board of Accounts shall publish a list of audited entities declared unauditable on the State Board of Accounts website. This should be very rare. And we're talking, it has happened. If we go, I actually was in an audit once where I went in, I think 6 times in 18 months, and they didn't give me a ledger. I mean, that bank account, it was a small town, but they could not get me a ledger. They couldn't even tell me, they didn't have all the receipts. They didn't have any way for us to form any kind of opinion on that. What we've done in the past is we would just disclaim the opinion, or, take 2 years to try to get something, or disclaim opinion. That's really not valuable to the citizens who want to know what's going on in their community. And so this is a way for us to give a mechanism for those particular units to say, you have got to get this straightened out, even if it requires you to get a consultant or outside help to come in and bring these records into control. But again, I can't imagine it at a county level. I would hope it never happens at a county level, but it should be pretty rare even for the smaller units. It did amend the section of statute about our State Board of Accounts called meetings. We will now be, well, we always kept registration, kept track of who attended the meetings, because that's how we got your certificates for that. But we will now keeping track of that. And if you do not meet the requirement that's in the statute that you attend a state called meeting at least a minimum of once every 2 years, then we will publish that on the website as well. And finally, there is a requirement, as you are aware, for auditors, clerks, treasurers, recorders. You are required to get a minimum amount of continued professional education each year. It's 15 hours in the first year and then 40 hours over the next 3. You are now going to be required to certify that you've met your requirement each year, and you're going to have to submit that certification to us. We're not sure exactly how that's going to work, and I think we're going to get back to you, but it will probably be through Gateway, similar to the upload process. It'll just be a form that you'll complete and sign and just upload the actual form. $1041 was also a State Board of Accounts bill. It had some of the same language that was in 1040, and I'm not going to go over that again. One of the things that did change is a statute currently requires you, as Stacy was pointing out this morning, requires you to file your annual financial report no later than 60 days after the close of your fiscal year for counties. That is December 31st. It's a calendar year end as well as fiscal year end. That language has been removed. It now states that the deadline is part of our uniform compliance guidelines. It allows the examiner then some flexibility for maybe smaller units to move that date up without having to change the law. We are going to, still for counties, it's going to be March 1st. Instead of the 60 days, we're just going to say March 1st because leap year just messed everything up anyway. So it will continue to be March 1st, but instead of being the statute, you'll find it in your manuals. This was a bill on law enforcement recordings, and those have been, I think recently, last 2 or 3 years, that they've had procedures for allowing copies of those and charges for those. All this does is add that a direct cost, because you can only charge a fee for the direct cost of providing the copies, can include the labor required to obscure non-disclosable information and perform an administrative review to determine if all non-disclosable information has been obscured in a law enforcement recording. If you have an attorney do that administrative review, that cannot exceed reasonable attorney fees, but you can add the cost for someone doing that work to the cost of them purchasing that recording. And I'm sure you have already heard about this. House Bill 1167 on live streaming now requires for counties, it's going to apply to commissioners and council and any other governing body that conducts their meetings in the same meeting room as the commissioners or council. It's interesting. But they must provide on a publicly accessible platform a live transmission of the meeting and then an archive. You have to copy it, an archive copy of that live transmission. Both of those have to be available. Each archived, where you archive it and have it accessible on your website, has to include a link to the agenda, minutes, and memorandum. If you are a unit that does not have the ability to live stream or don't have an internet presence, you can record them, but then you have to make those recordings available and you will have to hold on to those recordings. If you have a technological failure that prevents or disrupts it, it does not negate the public meeting. As much as possible, they want you to live stream it, but if something happens that interrupts that, it's a technical, like I said, technical difficulty or something comes up, that doesn't mean that the meeting has to end and you have to wait till you get your technical issues solved. You will need to comply in all other ways, but again, that's one you should look over because it's going to affect all of your commissioner and council meetings. I'm not going to go over this in any detail. It's just a new notice in case you have anything like this, but there is, requirement now that if for nonprofits that their privacy be protected. So if you have access to that, you cannot release personal information, which can include the list, record, registry, roll, or roster that identifies a person, member, supporter, or volunteer, or donor of a non-for-profit. So you're aware of that. 1293 was on the corners. I think the two things to note on that is that they have a totally separate now record retention policy that's built into their statute. So they're not going to be following the same record retention schedule statute that you in 515 that you all follow. They do have separate rules. Also, they put some different language in for costs, which may affect you at some point. So if a death occurs in one county, but the incident causing the death occurs in a different county, the two corners have to agree before the county where the death occurs is the other county is required to pay any cost for the autopsy. It's just they do have to confer on that. The DLGF bill, that's a really long bill. It's like 282 pages. I'm again assuming that DLGF will be issuing a memo or webinar for this bill. So there's a lot of things. I just kind of tried to hit some of the highlights so you know where they were. They're in that bill and which particular statute was affected. So there's several here. I'm not going to read all of them to you. You can read them and you know where you can find them. Okay, we had some questions. I think this came up at the recorders, but there is in the DLGF bill the requirement that you, as an auditor, you cannot deny an application for homestead deduction if the only reason you're denying it is because their driver's license does not have their homestead address on it. Doesn't mean you can't confirm that it is their homestead. It's just that you can't do it solely for the reason that the driver's license doesn't have it yet, or state ID. This one we're going to have to get more guidance to you on this. The first bullet point is about a tax amnesty program. This is county option, but there is in both of these statutes were modified so that there is information on doing an amnesty program to try to get property taxes paid up, providing a waiver of interest. So that's something your county council commissioners would have to look into and decide what they want to do. There is on your food, and if you're a county that has a food and beverage tax under 6.9, you are going to have to provide an annual report with a detail of expenditures by funds and how much money goes to any other governmental entities or instrumentalities out of that food and beverage. And that is going to be turned into the State Board of Accounts, and then we're going to turn it over to DLGF, and they're going to publish it on their website or on the gateway, I think. If your county makes any kind of final decision about that expenditure rate, where the county allocates who, what part of that goes where, and there's a lot of things coming out of that now. But if it has a detrimental effect or decreases taxing units amount of income tax, they need to make the decision before August 1st, and they need to notify that unit within 15 days of what the change is going to be to the amount of local income tax they're going to be receiving. It does provide a maximum tax rate. So and I think they change it almost every year on the tax rate for the correctional facilities and rehabilitation facilities, which that comes out of the public safety. If your county has issued bonds or a lease agreement with a pledge of lit, then your tax rate cannot exceed 0.3%. If there are no bonds or lease agreements, the tax rate cannot exceed more than 0.2%. So it's affecting how much you can actually raise for the jail facilities or rehabilitation facilities. And then it has changed how you calculate how much can be used on operating expenses. Can be no more than 0.2% of the tax rate imposed. Before it was like 20%, but it's now 0.2% of the tax rate imposed. Which is about the same, actually. Okay, again, if you have a food and beverage tax, you are required now to report to us any outstanding debt for that, and that has to be done annually. They did some corrective language, so the recorder still had a section of statute that they had to notify you, provide you with mortgage releases each month. And since we're not doing them, you guys are not doing a mortgage deduction anymore, they just took that out of the statute. So you probably have not been receiving them anyway, but just so you know, you're not going to receive them. And then there were several things that were changed on in 36714, which is your redevelopment commission. They're always changing things in that. One of the things they changed is that the president and vice president of the RDC can no longer be from the same appointing authority. So if the county's appointing one and the city's appointing one, they've got to be from different appointing authorities or commissioners or council, however it's happening. Okay. Now that by December 1st of each year, so this is effective next year, 1/1/24, the redevelopment commission is going to have to file with DLGF and with your executive and fiscal body a report setting out a spending plan for the next calendar year, describing their planned expenses. They have to notify those three sources of what they're going to do with the TIF revenues for the next year. Okay, and these are some additional, oops, I went too far, didn't I? I did. Went too far here. So the jury compensation changed. So what the clerk is going to collect, the fee is increased to $6 or $75 from a civil party. And the amount that you pay the jurors is going to increase $30 per day. It was 15 for any for attending, then $80 per day once the jury is impaneled until the 5th day of the trial. And after the 5th day, they're going to get $90 per day. And again, these are some changes also in assessment and collection, and DLGF will be giving you more information on that. Just about done. And this is adding that we talked about earlier, that covered persons for the restricted addresses. We talked about that earlier. This bill just adds regular or paid firefighter or volunteer firefighter as people that can request. They have to give you a letter, a written request that their information be removed. House Bill 627 is about sale of tax sale property. Again, affects that tax sale at 1.124. There was a provision that allowed in Marion County for those tax sale properties to be sold to nonprofits. It is now expanded to all counties. And 1639 is on watershed development. This allows one or more counties to come together if they choose to form a watershed development, which is going to be looking at issues like water management, stormwater management, drainage, things like that. There are series of procedures that are in there on how you have to do that, how you have to work with DNR to get that done. Funding will come from the participating counties in the commission. There's 3 different alternative choices of funding. If you have the situation, let us know and we can work with you on how, after your county chooses which one they want to do, how to take care of that. I'm done. I talked too much, but I'm done.
You're not done.
You did great, Lori.
You did do good, Lori. We had a couple questions that came in. I answered the best I could, but for now, we'll go ahead and turn it over to Stacy.
I will be coming to the quad personal, so I will bring all this with me, so you can ask him during the Q&A as well.
It's true. All right, Stacy, you're up.
Okie dokie. You think I'd remember how to do all of this? Okay, share my. Okay, do that. Then, oh, and share. Can you see my presentation?
Yes.
Yes, you're good to go.
Okay. Where on earth did... Okay, there's that. Okay. Well, I have some bad news. I didn't put any baby pictures in this presentation, so
Aw.
I'm sorry. But maybe y'all need to stand up and just do some jumping jacks real quick, because I ate a cheeseburger for lunch and I'm exhausted. Lori tired me out.
Oh my
But
fault.
it's okay. I'm gonna get into internal controls. I'm gonna try to, I don't know how I can spice it up, but I'm going to try to make it worth your guys' while. And hopefully we'll focus on risk assessment and monitoring so we can kind of get your brains thinking a little bit differently. But of course, I'm going to talk about all the components of internal controls. So stay tuned. Oh, let's try now. Next slide. Okay, there we go. Um, what are internal controls? Why do we need them? In government missions and objectives, changes and it evolves as result of various factors such as new management, change in staff, rapid growth, technology, new programs or services. As missions and objectives change, internal controls must be monitored and evaluated for applicability in new contexts and adjusted accordingly. So, like we've discussed, this is a continuing process. Once you establish them, they're not just done. Often, new internal controls are implemented without removal of old internal controls. Maintaining processes which have no clear purpose foster confusion and ineffective utilization of resources. Therefore, internal controls should be identified, monitored, and evaluated on a continual basis. So again, yes, ongoing process. To start the conversation on internal controls, let's just discuss what they are and why we actually need them. I know you're all just can't wait. You're at the edge of your seats. Internal controls is defined as the process by which management structures an organization to provide assurance that an entity operates effectively and efficiently, has a reliable financial reporting system, and complies with applicable laws and regulations. In this process is executed by officials and employees, which is designed to provide reasonable assurance that the mission objectives, like we discussed, the internal control process includes any policy system or action that corresponds directly to the objective of the organization and adjust to change when necessary. So again, we're adjusting when necessary. Um, so hopefully you realize how I emphasized that. Yes, the definition of internal control is broad. Internal control is a conceptual process that is applied to a wide range of situations throughout your office. The State Board of Accounts defines internal controls as follows. Internal control is a process executed by officials and employees that is designated to provide reasonable assurance that objectives of the political subdivision will be achieved. It is a basic element fundamental to the organization rather than list of added on tasks. So it is an adaptable process that, again, means there's no end in itself. It is focused on the achievement of objectives and it is dependent on officials and employees for effective implementation. So it's up to you guys to make sure that your internal control processes are in place, they're being assessed, they're being monitored, they're working efficiently and properly. So now that we've defined this, let's discuss the purpose. There are many benefits of a well-defined, relevant internal control process. The process produces accountability and transparency that can be seen internally and externally. Internally, the accomplishment of objectives may be quickly elevated. This could be any efficiency being addressed and corrected immediately. The purpose of internal control process is to provide reasonable assurance, again, that the mission and objectives of an organization will be achieved. So you want to achieve your objectives. So what are you trying to do? Again, you guys have a lot of duties. This purpose includes the reduction of risk associated with fraud, as well as safeguards of resources against loss due to waste, abuse, mismanagement, or errors. Internal control provides check and balance system over operations, promoting operational effectiveness and efficiency. A system of sufficient internal control procedures, reliable financial management data ensures accuracy and timeliness in reporting and promotes compliance with laws. So you want to encourage, we want to just encourage efficiency throughout the county and use your time and resources effectively. That's what your internal controls are supposed to do. Measure goals and objectives, allow the county to externally communicate success. So that people can see that you guys are doing your work effectively and achieving those missions and goals. Um, Now that we know what internal controls are and the processes of those, let's discuss the 5 components of internal controls, which I know that you guys know these by heart because Lori has told you for many years what they're about. The 5 components. Each of the 5 components of internal controls is necessary to form a complete internal control process. So, control environment, risk assessment, control activities, information and communication, and monitoring activities. If any of the 5 components is missing, true internal control is not achieved. Additionally, each component is comprised of recognized principal elements, 17 to be exact. To have a complete component, the principle associated with each component should be present. So we are going to talk about these 17 principles. I'm not going to read this slide to you or the next because I just wanted to detail out the 17 principles. But what I'm going to do, here's the second 8 of the 17. We're going to group these principles into the components in which they go with and kind of how do you achieve those missions and goals that we keep talking about. Okay, so we're going to start with control environment or the tone at the top. This is also known as the foundation for a sound internal control system. This is where we start, which I know has been discussed before, so bear with me. The oversight body and management convey leadership expectations and overall tone, which are reinforced by all officials and management throughout the various offices and departments. The control environment also contains the overall accountability structure for all employees through performance and reward measures. Within this structure, leadership demonstrates commitment to the political subdivision by having a process for attracting, developing, and retaining component individuals. So the 5 of the 17 principles that are listed on the slide. 1, the oversight body and management demonstrate a commitment to integrity and ethical values. The oversight body and management demonstrate these values through directives, attitudes, and behaviors. That's why it's the tone at the top. Established standards of conduct are expected to be observed by all throughout the political subdivision. So at the county, you should be seeing this. You should, if you have, what is your mission? What are your ethical goals? Like, what are you wanting to do? Like, this should be seen throughout the county. As part of the commitment to an overall system of internal controls, the oversight body develops and implements a formal ethics policy in order to ensure the policy is communicated to each person, a system of annual acknowledgement. Like these are just some things that could be done as examples. Principle 2. The oversight body oversees the entity's internal control system. There is an oversight structure in place. The oversight body oversees management, design, implementation, operation of the county's internal control system. So what controls do you have in place? So can think of the environment and what you have set in place and the oversight that there is. Management provides documented control processes. The to the oversight body for review and input. The oversight body should analyze the internal control system for weaknesses on an entity-wide basis as well as on a departmental basis. Identify those offices and departments that utilize the oversight body as a resource for ideas. So make sure that they're looking at the county as a whole and not just looking at one department and forgetting the others. You want to make sure that internal controls are effective in all areas of the county. And sometimes these can slip through the cracks. That's why it's important to monitor and assess risks. Principle 3, management establishes an organizational structure, assigns responsibility, and delegates authority to achieve the political subdivision's objectives. The organizational structure is designed so that it's clear where responsibilities are, especially for those areas where statute has not assigned particular responsibilities. So it's kind of outlining who is responsible for this, who's doing this from start to finish. When needed, management will go back to the legislative body to enact the policies that will clearly define these areas, specifically when the organizational structure extends beyond office or department boundaries. So you just might need that clarity. So make sure that this is being looked at. Examples include, but not limited to, like an organizational chart, an outline of specific duties within the organizational structure, documentation of internal control procedures over specific accounting areas. So I mean, again, you guys should have these already in place because we have, I don't want to say harped, but we have presented on these multiple times. So control environment is something that we believe you're getting the understanding of. It's just how do we make sure our controls are in place. So principle 4, management demonstrates a commitment to attractive development and retain competent individuals. So policies pertaining to recruitment, training, mentoring, and retention of personnel. How are you keeping your employees? You know, are they identified in key roles? Management determines the skill necessary for each level of the organization. So examples could include, but not limited to, creating job descriptions and determining skills necessary to perform the job, tracking training schedules and review courses for each employee, completing evaluations on a regular basis, addressing any deficiencies in skills. And then principle 5, management evaluates performance and holds individual accountable for the internal control responsibilities. Individuals are held accountable for their internal control responsibilities through a recognized understood structure, which includes corrective action procedures. Additionally, management evaluates for excessive pressures on personnel and adjusts these pressures accordingly. So the oversight body establishes overall policies with objectives that cross over office and departments. So yes, these 5 principles are a lot, but they should make sense. Most of the time, if no oversight is happening, employees will not be as worried about making mistakes, not having structure, authority, and a responsibility, and it just breeds chaos. So, without a commitment to um, without a commitment, things can be done wrong. So you just want to make sure that, again, control environment. It's your tone at the top. You want to make sure that your ethics and values are being presented throughout your county, and so that your employees will follow those and they lead and follow management. So you want to just make sure that you do have good ethical values and integrity, and stress the importance of that, and communicate it through their job responsibilities so that they feel good about what they're doing. So that's the last I'm going to touch on, control environment. Let's talk about control activities. Again, control activities are the actions and tools established through policies and procedures that help to detect, prevent, or reduce the identified risk that interfere with the achievement of objectives. So, detection activities are designed to identify unfavorable events in a timely manner, whereas prevention activities are designed to deter the occurrence of an unfavorable event. This is something that we've talked about a lot, your control activities, because it's an integral part of the process, such as segregation of duties. That's why we stress segregation of duties so much. The basic purpose of segregation of duties is that an individual or small group of individuals should not be in a position to initiate, approve, undertake, and review the same action. So you want to make sure that those duties are separate. Separating the ability to record, authorize, and approve transactions along with handling of the related asset reduce the risk of error or fraudulent actions. It may reduce the risk of management override. So 3 of the 7 principles that we want to talk about. Principle 10, management designs control activities to achieve objectives and respond to risk. So control activities are designed to fulfill defined responsibilities and address identified risk. Um, The purpose of the control activity is performed as well as an evaluation of the effect the deficiency would have on objectives. Control activities may be either automated or manual. Some examples of this could include, but again, it's not an all-inclusive list, reviews by management at the functional or activity level, controls over information processing, physical controls over vulnerable assets. Another, again, segregation of duties. You just don't want one person doing everything. Accurate and timely reporting of transactions, access restrictions to and accountability for resources and records, and appropriate documentation of transactions and internal controls. Principle 11, management designs the political subdivision's information system and related control activities to achieve objectives and respond to risk. Control activities are designed to support the completeness, accuracy, and validity of information processing by technology, including the design of security management. So management evaluates changes to systems and updates control activities in response. Again, some examples that kind of help drive this home are like disaster recovery, ensures that critical accounting information will be processed in the event of an interruption of computer processing capability, or backup. What happens if something happens to your computer system? Do you have a backup off site so that if something were to happen, you have something in place? Audit trails allow for sufficient documentation to trace all transactions from the original source of entry into the system through all of the system processes and the results produced by the system. Again, segregation of duties can be achieved within information technology systems by appropriate assignment of security profiles. So you're making sure you're locking down your technology. You're making sure that you restrict the access to certain things for certain individuals, and you don't get everybody the same access. So this is something that is just an example of that principle. The last principle on this page is Principle 12. Management implements control activities through policies. So management works with each office or department in determining the policies necessary to address the objectives and related risks for the operational process. Further defines policies through day-to-day procedures may be warranted. These policies are periodically reviewed for continued relevance and effectiveness, so they're monitoring those. To summarize control activities, these are the policies and procedures that help mitigate the risk and support the achievement of the objectives that we talked about earlier. Policies establish what is expected while procedures put the policies into place. This is where most of our testing occurs. One piece of advice, as Ricky said she wanted me to make sure went in this presentation, is document, document, document. And I am document, document, document. Do you hear that? Me hitting my desk? Document. So document all reviews that are done. Do it, please. Thank you. Did I do it justice? Okay, thank you, Ricky. That's what I needed. Okay, I'm going to talk about the principles over information and communication, and then we're going to go back and talk about the big ticket items that I want to talk about today, which is risk assessment and monitoring. But before that, we need to talk about information and communication. This is relevant information from both internal and external sources is necessary to support the functioning of the other components of internal controls. So communication is the continual process of providing, sharing, and obtaining necessary information. Internal communication enables personnel to receive a clear message that control responsibilities are taken seriously by the organization. External communication enables relevant outside information to be internalized, and internal information can be clearly communicated to external parties. So 3 of the principles for information and communication are management uses quality information to achieve the political subdivision's objectives. So management defines the type of information needed and the acceptable sources of information. Then management can then process and evaluate the information for relevancy. Information should be appropriate, current, complete, accurate, accessible, and timely. Information must be relevant and of high quality for this to work. Principle 14, management internally communicates the necessary quality information to achieve the political subdivision's objectives. So information is communicated using established reporting lines. Appropriate communication methods consider the audience, the nature of the information, availability, costs, and all legal or regulatory requirements. In establishing a process of internal communication, management may consider some of the following, and again, these are just some examples. The form of communication and documentation of internal communications between offices, departments, and the oversight body is established and communicated to employees. So are you communicating with everybody? What it has been determined from the top all the way down? Like, do you have a clear way to get information to your employees about what they're supposed to be doing, their job duties, their responsibilities? Procedures are established to ensure that the communication requirements are being followed. So what you're putting out there, are people following the proper policies and procedures that are set in place. Procedures are established for feedback on a clarification of the information provided. So you're providing some open means of communication where if people have questions, they can talk to you about it. Internal memos and reports are maintained to document communication. So where are you seeing that information and communication and the documentation of it? Principle 15, which I believe is the last one on this slide. Um, Management externally communicates the necessary quality information to achieve the entity's objectives. So management identifies external parties and communicates relevant information. Appropriate communication methods are developed and should include the same consideration as outlined for internal communication. In establishing a process of external communication, management may consider some of these items: communications with State Board of Accounts or state agencies, grantor agencies, regulatory agencies, are documented by emails, memos, letters, other correspondence. Logs are kept for information provided verbally. So if you have a call with us, what do we say? We keep phone logs to document what we're talking to you guys about, what your questions are, and how we are providing answers and feedback, just in case if anything were to come up. Procedures are established to retain public documents. Reports are cross-checked for accuracy, relevancy, and timeliness of information. So to summarize information and communication, the one thing that has not changed is the need for information and communication. Information needs to be quality and be relevant. Communication needs to be both internal and external. Okay, I know you guys are so excited for what is risk assessment, what is risk, and what is risk assessment. So I'm just not going to be around the bush. We're just going to get right into it. Okay. The definition of risk is the possibility that an event will occur and adversely affect the achievement of objectives. So, are you assessing risk when it comes to your internal controls? So, I want you to think about that. So, you might have your policies and procedures over internal controls in place. Are your controls effective? If you have audit comments regarding internal controls, it's a possibility that in their deficiencies are identified. It's a possibility you might have deficiencies. So your internal controls might need to be assessed. It might be something that you need to go back and think about because you might not be assessing risk and you might not be monitoring it. So let's talk about risk assessment. Risk assessment is the process used to identify and assess internal and external risks to the achievement of objectives and then establish risk tolerance. So each identified risk is evaluated in terms of its impact and likelihood of occurrence. Overall risk assessment is the basis for determining how risk will be managed. So let's think about this as we discuss. The what, the where are the risks that our objectives will not be met. So that's something that you might want to think about because, again, it all goes back to the objectives. These 5 components are really intertwined. So it's like you have your control environment and your control activities established. They're all based off of your objective and your mission. So where are the risks? that stop you from getting to your objectives. So we're going to spend the next 4 slides going over the 4 principles which apply to risk assessment, and I'm going to try and give you a little bit more insight and really like think about how we can assess risk at the local unit level. So principle 6, management defines objectives clearly to enable the identification of risk and risk tolerance. Let me just make sure I'm good on time. I have until 2:30. It's 2:18. Okay. Objective defined in clear terms will include information such as who is to achieve the objective, how the objective will be achieved, and when the objective will be achieved. So when, how, who. Objectives fall within 3 major categories: operations, so effectiveness and efficiency of operations; reporting, reliability of reporting for internal and external use; compliance with applicable laws and regulations. So as a part of the process, as a part of this process, the oversight body may consider these some of consider some of these. Defining objectives in specific measurable terms in order to enable the design of internal control for related risk. So how can we measure this? How can we measure the risk? Identifying what is to be achieved. So again, what do we need to achieve? Who is to achieve it? How will it be achieved? And when will it be achieved? So I don't know if you want to think of what needs to be done, who needs to do it, how are we going to do it, and when will it be achieved? These might be something that you just need to ask whenever you're assessing your risk. Incorporating external requirements such as state statutes and uniform compliance guidelines, including a subset for the 3 categories which addresses the safeguarding of assets. So you just need to think of that. So if we get anything from this slide, it's the who, the what, the where, the how. Are we going to assess these risks? Did I go to the next slide? Yes, principle 7. Management identifies, analyzes, and responds to risk related to achieving the defined objective. So management identifies risk to achieve the achievement of the county's objectives across the county as a whole, and within each office or department, analyze the risk through determination of objective measures. So the measuring that we were talking about previously, we need to analyze those risks. The response to risk is selected either acceptance, avoidance, reduction, or sharing. In the identification process, management recognizes the various types of risk at the entity and transaction level for each objective. So for example, risk factors may include the organizational structure, new technology, complexity of a program or transaction. Is it a complicated process? Is this a new or amendment to a law, kind of like all of the new laws or amendments that Lori talked about previously, or economic instability. So management needs to make sure that they analyze and identify risks to estimate the effect that this is going to have on possible controls. For example, how likely is the risk to occur? So this might be something that you need to ask. How will it impact the objective? Is the risk based on complex or unusual transactions? Is the risk based on fraud? So these are just things that you need to keep in mind whenever you're kind of if you think about this slide. So if there's anything to take away, like to analyze risk, how likely is the risk to occur? How will it impact the objectives? Is the risk complex or unusual? And is the risk based on fraud? Is it something that's fraudulently happening? Is it like a random instance? Principle 8, management considers the political potential for fraud when identifying, analyzing, and responding to risk. So the types of fraud which could impact the achievement of the county's objectives include fraudulent financial reporting, misappropriation of assets, and corruption. As a part of this analysis, fraud risk factors are identified, such as pressure, opportunity, rationalization. The response to fraud risk exercises the same process used for all analyzed risks. So anything that we talked about on the previous slide. Management considers the types of fraud which can occur, such as fraudulent financial reporting, misappropriation of assets, and illegal acts. So the analysis and response to fraud risk is similar to the procedure set for the analysis and response to risk in the previous principle. So again, this is very similar to the previous one, but more so based off misappropriations of funds, illegal acts, possible fraud. And I believe this is the last principle I want to talk about. Then I'm going to summarize risk assessment, and I might need to fly through monitoring, but that one's easier than this one. Management identifies, analyzes, and responds to significant changes that could impact the internal control system. So internal control is a process, and part of the process is the responsibility for management to be continually aware of changes, both internal and external, that could affect the achievement of, again, the objectives that we've been talking about. Those changes should be analyzed for both their immediate effect and for any future impact. So you need to think of what could happen now, what could happen in the future. Management would determine any modifications needed to the internal control process to adapt the changes. Oh, we just talked about changing it because it's an ongoing process. So that's what risk assessment, when we assess the risk, we might need to make changes. Internal control procedures require evaluation and adjustment on a regular basis to accommodate the impact of future changes. So again, if it's technology, new programs, new laws, what do we need to do? Some of these examples could be new employees receive training on internal controls and employee policies. New software requires reevaluation of policies. It's a continuing changing process, and we use this risk assessment to do that. So again, since we'd focused on control activities, we wanted to talk about this risk assessment. So that's why we're hitting this so hard. Before you can establish procedures, you need to set the goals that you are wanting to achieve. So for risk assessment, set your goals. What are you wanting to achieve? The goal might be generate accurate fund ledger reports each month. It might be something to where it's like, I want to make sure accuracy in reporting. Then you need to identify what risk that would prevent you from achieving those goals. Those risks might include like all disbursements have not been posted by month end. All receipts have not been posted by month end. Payroll transactions haven't been posted properly. Maybe there was a reconciling issue between the auditor and the treasurer. Transfers, adjustments, and corrections had not been completed timely. These are risks that you might need to assess and incorporate. And as you continue until you identify all the risk, it is possible as you identify risk that more risk will become identified. So it's a possibility that you're assessing it, you find more issues. But the thing is, when you find those issues and you assess the risk, you need to formulate a plan to address the risk. So how are you going? What changes do you need to make? So with the risks that you identified, you need to analyze the risk and determine how great of a risk is it. Prioritize which ones need to be addressed first. Then you can formulate a plan to address it. Policies and procedures could be changed easily. At the time, you need to determine your risk tolerance. While it theoretically possible to establish activities that prevent errors or detect and correct errors down to the last penny, no, it's not. Something could happen. It could be human error, but you just need to be able to possibly assess that risk. What's the likeliness that something could happen? So let me talk about monitoring in 3 minutes. So let's talk about monitoring. I will try and do you guys have these slides? So I'm just going to go through the definition of monitoring. I'm going to skip the principles and go to my summary page. So then I don't cut into Ricky's time too bad. Monitoring is defined as activities currently in place to evaluate the effectiveness of mitigation management activities for each sub-risk. So, okay. So monitoring is the other side of risk assessment. You need all 5 components. If you don't monitor, you don't know who will your policies and procedure. You don't know that your policies and procedures are working. The audit is not and should not be the assessment of your internal controls. We do not audit to place an opinion on your internal controls. You should be monitoring and assessing the quality of performance over time as if these controls are working. If you have an audit result and comment, then you do have to address that and incorporate it into the risk assessment and control activities. You will also need to include it in your monitoring to ensure that is working. The problem has been resolved before the next audit. If you find that control activities are not working, are not preventing or detecting errors, those findings are as important as any audit findings. You need to address those promptly. So whenever there is an issue, you need to address it right away. Don't just leave it for a day when you're less busy, because we know that that's not a thing. What went wrong? What didn't work and what didn't work, and how can you make it better? Monitoring should be an ongoing process throughout the year, but you should also have some separate evaluations where you can look specifically at controls to make sure that they are working and designed properly and to prevent errors and fraud. So that's all I have. Ricky, how did I do? Oh, a minute to spare.
You did good. I do want to add one thing.
Yeah.
Just we were talking about internal controls, and during the financial statements, you're right, we don't audit it and do an opinion, but we do with the federal. So make sure you understand that when we are looking at the federal grants that we talked about earlier, internal controls are a vital part of that, and we do audit those controls in place for each major program. Yay, that was good, Stacy.
I'm tired, so I'm gonna take a nap during Ricky's. See you all later. I'm just kidding. I can't wait to hear what you have to say.
Well, I have a half an hour to talk about. This is going to be the portion. We got a smiley face that just jumped up the screen.
A laughing one, yeah. I don't know where that came from, but that was
I don't
fun.
know where that came from, but that was fun. Anyway, this presentation is called Working Together. So it's kind of a meld of several different presentations because, as you guys know, we're going to bring treasurers in. There's probably some still on the call now. We're going to bring them in at the quad meetings and do some discussion, some open discussions. We hope that the same auditor and treasurer from the same county can go to meetings together because that does help to promote communication between the offices. But we just want to talk about it. We did this a few years ago. It was really great to open the door, get some conversations rolling so that everybody's on the same page of the processes, because both of these offices are vitally important, right? They're two sides of the same coin. You need each other moving forward. And so working together is, again, important. So let's share my screen. Share my screen. Can you see my screen? Okay, and you can actually see presentation. I have a thumbs up. Perfect. Wait. Oh, okay, I just got kind of an error. Okay. So this is going to be a very brief. Okay, so I've got 29 minutes to kind of get through here. So this is just kind of a brief overview of the two offices. Again, we'll do a deep dive when we bring you guys together. But we just kind of want to touch on the processes as a whole. First, I wanted to start talking about segregation of duties. So Stacy talked about that. She talked about that in her internal control thing that we just got done listening to. And so the one good thing about segregation of duties, especially when it comes to your auditor and your treasurer, is a lot of it is written in statute. And we're going to get to that. But segregation of duties really is based on the fundamental premise, right? That one individual cannot initiate, approve, undertake, or review the same action. It separates that ability, right, to record, authorize, approve, along with handling related assets. It reduces the risk of error and fraud. Okay, so when we look at some of the bigger fraud cases that come across, they almost exclusively include one person controlling the whole process. One person was allowed to control that, and then was able to you know, to initiate some sort of fraud or theft, and then they were able to cover it up, right? Because it's one person involved in all of those processes. So segregation of duties does protect local government from this kind of theft. It also protects employees, as properly designed and implemented controls show that fraud or theft hasn't occurred, and even shows human error hasn't occurred. I mean, I've miscounted money before. It's just a protection, right? So we just want to ensure that, our newly elected understand the processes that we're getting ready to go through, along with our, get auditors and treasurers all on the same page. So again, the segregation of duties between auditor and treasurer is found in statute. Obviously, our audit positions that you have to comply with statute. So where statute prescribes a specific authority to an office, that can't be delegated to another office. However, it is possible to establish compensating controls if true segregation of duties is not possible. If you have like a small office, it does get a little bit more difficult. It's not impossible. It does get a little bit more difficult to spread it around, right? If this is you and you want to brainstorm ideas, there are 3 people in this meeting right now who would love to have a phone call. We'll talk to you. We'll brainstorm with you. 2 things to remember about this is we can't write your internal controls for you, right? You must establish them within your own office. We can help by offering ideas. We can explain certain needs or, things that come up. We also can't ever tell you that your controls are perfectly designed, right? Well, you're never going to call Lori up and say, Lori, I think I've got the most perfect control. It's just perfect. She's never going to say, yes, it's absolutely perfect. This is what's going to happen during an audit setting, right? They need to come in, they need to see it, they need to look at the entire process as a whole, and do it from an audit standpoint. All right, so moving on, I want to talk about the accounting process that's kind of broken up into steps that should be segregated and are segregated between the offices. I keep looking at the screen because I have you guys over here. I'm going to move you. All right. So the accounting process, again, is broken out in steps here. It's going to be segregated between your offices. So authorizing is the initiating of a transaction. And for the time being, we're going to focus on receiving and disbursement currently, and then we'll move. But for receiving, we're talking about the initial collection, the collection of funds into the treasury, so your receipts. For dispersing, this is the claims process, right? We wouldn't want the same individual doing all of these things within the county. So statutes assign segregation of duties, and let's take a look at that. Custody of the cash and investments of the county from which the receiving and dispersing takes place, right? Record keeping is how we track the receipts, disbursements, and fund balances. These are the financial records of the county. And reconciliation is the process of comparing the county's financial records with the cash and investment balances to support those financial records. All right. So initiating and approving the transactions of receiving and dispersing from county funds. So as an aside, the treasurer's office does collect property taxes for all the taxing districts in the county, and those collections are maintained on the cash book until settlement. It is at settlement that property taxes are receipted into the county funds for the distribution of those taxes. When we're For the purposes of this presentation and, for discussing receipting, we're just not including settlement. Settlement is its own process that needs its own conversation. So we're not going to be talking about that process today. So in addition to the receipting and dispersing authorization, the auditor records these transactions in the official record of the county, which is the funds ledger. The auditor's funds ledger, again, is the official record for the county and the basis for the annual financial report, or the AFR, for the county each year. Okay, so for receipting, statute provides that the auditor shall keep an accurate record current with the county treasurer and issue the quietus. So the quietus is the official document that the receipt has been posted to the funds ledger. The receipting process starts with the auditor, and the quietus is the basis for posting the receipt to the appropriate fund. At the same time, the treasurer takes custody of the funds, and the two offices must agree, which means what is posted to the funds ledger must be accounted for in the treasury and maintained by the treasurer. The auditor reviews all claims filed against the county funds and issues a warrant for payment. A warrant is not a check, okay? A warrant is really an order to pay, and that warrant is provided to the treasurer, who will then make the payment, whether by check or electronic of some sort. I want to be clear, because the term warrant and check are kind of used interchangeably, but in statute, what I just talked about is the warrant as being the order to pay and not the actual check, is how statute is written, right? But in common terms, and with technology taking place, the check has kind of replaced it, right? So we use those interchangeably, but you have to keep in mind that it's, as the auditor issues the warrant, it can't go out the door yet, right? Without the treasurer, okay? So, and we'll get to the treasurers in just a second. But it does say that the auditor shall issue warrants. It's not saying that the auditor shall issue the checks. It means the auditor has audited the claim and determined that it's a valid claim against the county and that payment is due in a specified amount, okay? Along with saying that there's an appropriation available. As the warrant is an order to the treasurer to pay out the claim, the treasurer then issues the check or the ACH or whatever other payment there is. County checks will have two signatures, one from the auditor and one from the treasurer, to show both have completed their duties regarding the claims against the county. All right, if we move to the treasurer is the custodian of the county treasury. That means the treasurer is the gatekeeper for the treasury. So no money enters or leaves the treasury except under authorization of the treasurer. We'll talk about electronic deposits and if it's possible for departments to make deposits into a county bank account later. But for now, the treasurer is still responsible for posting receipts to the cash book and providing documentation to the auditor of these deposits. The treasurer is also the investment officer for the county. The treasurer of state's office, presents a lot to them and what they need to do and how they need to invest. The treasurer has the responsibility to reconcile the cash book to the bank balance and investment statements. Reconciling just means to make two records agree. So the bank and investment statements are the financial institution's financial records, not the county's. They provide a statement of the accounts to the treasurer, who then should compare their records, their records to the bank records. This is important. Like I said, the funds ledger is the basis for the annual financial report, and it's going to need to reconcile to the bank and investments as well, right? So it's both offices working together to make sure that those are in agreement. Okay. Here's the statute on the treasurer as the custodian of the money held by county receipts. Again, payments out of the treasury must be approved by the treasurer before they can be made. I have to move a little quicker here. Okay, so we've already kind of discussed that the auditor audits and determines the validity of the claims. The treasurer does not have the responsibility to audit those claims once presented by the auditor. After approval of the governing boards, however, the treasurer does have the responsibility to determine that there is sufficient money in the treasury to pay those claims. So again, no one should be guessing if there's enough money in the payroll bank account to cover payroll. The treasurer's to make that determination before the payroll checks are issued or direct deposits are made. Remember our definition of segregation of duties. It should not be possible for one person to approve a claim, create a check, affix a signature to that check, print that check, and deliver that check. It does not mean that checks can't be generated by the software or that signatures can't be affixed by the software, but control over those signatures must be maintained. There must be internal controls in place to prevent someone in the auditor's office from writing, signing, and issuing checks without the treasurer, just as there must be controls in place to prevent someone in the treasurer's office from writing and issuing a check that does not have the claim approved by the auditor. All right, I'm going to speed up because this isn't even like half my slides. So we're going to go through this fairly quickly. So this is going to be the receipting process. This is the paper form prescribed receipting process. Okay, so that's going to be my caveat. You have systems in place that do some of this now, but it should flow very much the same way. Okay, and if you have questions about it, we can dig into it at the in person. So I'm going to just go quickly through this receipting process. Okay, so we're really talking about department collections, right? So I'm a department. I'm going to start by going to the auditor. The auditor should be creating an application to pay. Okay. Most counties have, again, software that can do this. This is the document that is prepared that's going to show the date, the funds that are going to be credited, the amount, the person paying, and the source of the payment. Once the auditor does the application to pay, they don't take money, right, at this time. The auditors are not taking the department's money. They are not the custodians of the cash, right? They're just starting the process. Once this is done, as the department, we're going to take our collections over to the treasurer's office, right? So you're going to take the application to pay that's obtained from your auditor to your treasurer, all right? Oh, sorry. Didn't mean to do that. I think I'm back. Okay. When you're taking that over there, the money is then counted and the treasurer should issue a receipt to the person paying. All right. So then the receipt that I'm going to get is that I transferred money to them. I gave them my money. I have a receipt that says I gave the treasurer my money. So a copy of the treasurer's receipt is returned to the auditor. So now the auditor knows that that money has been taken by the treasurer, right? They take that receipt to the auditor and then a quietus is issued by the auditor to the person paying and posted to the funds ledger. Okay. Am I still here? Sorry, I had a glitch. You can hear me? Okay. All right, so same kind of thing goes with ACH and electronic deposits. We'll quickly go over here. So in these cases, there is no report of collections, right? So the revenue is placed directly into the bank account. However, you should have documentation from the source of the payment, whether it's the state, whether it's the feds, on what should be posted and deposited, okay? The source document should be the basis for the quietus process and posting to the funds ledger. All right. So sometimes issues will come up when the money has been deposited, but the information needed for the quietus is not available for whatever reason. It is possible for there to be a delay between the deposit in the bank and posting to the records as payments are being researched, but this really should just be a matter of days, not weeks, not months. Okay. All right, so let's jump to the dispersing process. As auditors, we should be pretty familiar with it. So we're going to start with an appropriation or a budget that is set by your county council, right? Y'all, the new ones will go through that budget process, for next year. We all know that it's a long process, a big process, trying to determine how much money you're going to have, how much money you're going to be available to spend in that budget. But the council sets those budgets and appropriations. The auditor receives the claims, the invoices, the supporting documentation. Once those claims are received, then they're going to follow statute, right? In 511-1016. So you're going to have a fully itemized invoice or bill, right? It should be approved by the person who received the goods or service, right? The invoice or bill is filed with the auditor as the fiscal officer. Once we go through, you're going to make sure that that bill or invoice is true and correct, right? That's what you're certifying on the claim. All these things line up, it adds up. It is true and correct in all senses of the word. Oop. And then before it can be paid out, it does have to go through an approval process, which is the governing board, right? So this is where once the claim has been audited, it is submitted to the governing board for approval of this claim, which in most cases is the commissioners, though there are some exceptions to the rules on this. If you've got like an RDC or you have a tourism commission, those kinds of things, there are some other boards that can approve claims. The auditor then prepares the warrant. In most cases, again, this warrant has been replaced by the check and then is given to the treasurer, who then verifies that there is enough balance in the bank account to pay that check for those claims. Once the treasurer has made that determination, the disbursement process can proceed for the checks to be printed and delivered. The auditor would then post disbursements to the fund ledger, just as the treasurer would post to their fund ledger. So while the auditor maintains the official records of the county, the treasurer is charged by statute to keep a separate accounting of receipts, disbursements, and fund balances for each fund. So this is based on the receiving and dispersing process. The treasurer has the information to be able to post their accounting of the funds. This should then be compared to the auditor's ledger at least monthly when reconciling. That's required. Some counties do it daily. It makes it easier for them when variances come up. But if any variances are detected, those will need to be, adjustments will need to be made. The total funds ledger is a subpart of the cash book. So the cash book records not only the totals from the fund ledger, but any property tax collections, some other tax collections that have not yet been settled with the auditor. All right, 8 minutes. Oh, okay. All right, so why do we reconcile? I always like to say that and say, well, statute tells us to, right? 513.6.1 says that all local investment officers shall reconcile at least monthly. It's also part of the accounting and uniform compliance guidelines, right? At all times, manual or computerized records, subsidiary ledgers, control ledgers, and reconciled bank balance must agree. But beyond that, reconciliation is a fundamental accounting process. It ensures that actual money spent or earned matches money leaving or entering a bank account at the end of a fiscal period, right? So, or at the end of the month. Reconciling the accounts is particularly important activity because it does give you an opportunity to check for fraudulent activity, to prevent financial statement errors, make sure something didn't go through twice, gives you a chance to find errors in a more timely manner. Okay. Teamwork. So, right, treasurer maintains custody of the cash, auditor maintains the official funds ledger. Both prepare a monthly report, and the funds ledgers need to be reconciled between the two offices. The funds ledger, the monthly report that we're talking about here is the monthly financial statement, or you will hear us talk fondly of the Form 61. Okay, this is just a sample. Nothing in this is accurate. In fact, it's from Pleasant County, not Perfect County, but Pleasant County today. This prescribed form is for the comparison of the ledgers on both the auditor and the treasurer side. However, again, if you've got a software, some softwares either have exact replicas of the Form 61, or they may have two reports that need to be used in order to be the equivalent of a Form 61, okay? When the auditor and the treasurer are looking at these, they need to be looking and reconciling each fund, their beginning balance, their receipts, their disbursements, and their ending balance, right? Everything should reconcile all the way across. There are some times when they don't agree. Maybe a transfer has taken place and, on the auditor side, but the treasurer was unaware. The books need to be adjusted to reflect that transfer. The more often you do this, the easier it is, again, to find any kind of posting errors or transactions that didn't get posted on both sides. It's much easier to do it daily than it is a month, but it's much easier, to do it a month than it is to wait for longer than that. Statute, again, makes the minimum monthly. All right, so what happens when they don't agree? Where do you look for variances? Again, you're going to look at the receipts. You're going to look at the warrants. Make sure that each is represented on each fund ledger. Are there other changes, correction of errors, voids of either quietus or a check, transfers of funds? Those kinds of things are the things you're looking for. All right. Oh, 4 minutes. Reporting. All right, so one thing I want to touch, since I have both auditors and treasurers here, is one of the requirements that is required to be uploaded monthly within Gateway is the documentation of the reconciliation of Form 61 between the auditor and treasurer. This is a required monthly upload. It is on both the auditor and the treasurer because both the auditor and treasurer are required to reconcile the Form 61s, right? So, but as far as Gateway is concerned, only one office has to upload. Okay, both can upload if it makes you feel better to make sure it's up there and both of you want to upload, by all means, go ahead. But only one has to. It varies from county to county. Sometimes the auditor wants to do it, sometimes the treasurer is the one who does it. Okay, so just want to take a moment to say that. Again, if you want to do it just to make sure that it's done, by all means, go ahead and upload it. It's never going to hurt to have it up there more than once. The only issue we have here is that treasurers cannot see if auditors uploaded, and auditors cannot see if treasurers uploaded. Okay, that's just not a capability. So this is something you'd have to work out at the county level. But I just wanted to make that point. All right, this is the supplemental AFR. Hopefully everybody has seen this since we're now in May. This is what is filled out by your departments that hold money outside of the auditor's ledger. Treasurers hold money outside of the auditor's ledger until that money, until it's either time for settlement or if there's something else. Normally, sometimes, well, no. So, and anytime that they're going to settle with the auditor, we can get into more details later. But this is the report you're going to use to tell the auditor what you still have on your cash book at the end of the year, so that it can be incorporated into the financial report that is uploaded within Gateway. This is just a form that's available on our website. If you go to the county's page and you kind of scroll down to Gateway, and then there's an annual report section. If you open that up, there will be the supplemental AFR. Oh. Okay. So I went through that very, very quickly, but really the goal here is to work together to provide accurate accounting for the county, right? A lot of times it takes respect, cooperation, and communication, which you all have. I've worked with a lot of you. I know that you all work really well, and I know you all want to do a very good job of accounting for the county's money, okay? I've never, in the time I've been here, I've never had an auditor or a treasurer come to me and say, I don't really care what happens to the money. I care to the penny, right? Like, I want to know what's going to happen. I got to make sure this happens. So we just encourage you to continue to working together. Saying that, again, we're always here. So you can call, ask any questions that you want. We'll try and help you. If something gets confused between the two offices, we don't even mind to sit down and go over your process. Or if you want to just run it by us and talk to us about it, give us a call and we'll do that. So that leads me to the end of this. Can I stop sharing? Am I back? Okay. So I want you to think about how your office works with the coordinating office. So auditors, think about how your office works with your treasurer. Treasurers, think about how your office works with the auditor. I want you to bring those conversations in. Let's talk about it. We really do want to make that process as smooth as possible. Again, you guys are both two sides of the same coin. We just want to work together and help you in any way we can to make the process as smooth as possible. Saying that, it is 3 o'clock. I feel like we gave you a ton of information in a very quick amount of time. Luckily, we'll be out next week. Tuesday, we'll be in Noblesville. Wednesday, we'll be up in Plymouth to start these. We will be writing down all questions that are asked during these quad meetings. Once we get all the questions together, they will go in the next bulletin. We'll answer all of them so that while you're at one meeting, you'll still get to see the questions and answers from another meeting. We want everybody to have the same information. And I think that's it. Do you guys have anything to add before we let them go?
No.
No. I hope you enjoyed today. I hope you got some information out of it. We look forward to seeing you all. I know Stacy's looking forward to meeting you all. We hope that you have a wonderful evening, and we'll see those who are attending in Noblesville on Tuesday. All right. Bye, guys.
Bye.
Oh, we got little smiley faces.